You're seeing a broadening beyond the kind of core AI names.
The AI story is driving a decent portion of growth.
The AI power and the AI infrastructure basket still looks really, really compelling.
It's a vibe market, and it's all driven from sentiment for the most part.
I think equities are still going up 15 to 20% from where they are over the next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, the government reopens.
So with my signature, the federal government will now resume normal operations, and my administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
The president's signature ending a record-long government shutdown. The White House warning you probably won't be getting last month's data as hawkish Fed officials are lining up to push back against further rate cuts. That chorus growing louder.
And that chorus is already very loud considering just how much Fed speak we've gotten yesterday, but also today and tomorrow. What we got yesterday, Boston Fed President Susan Collins, who is a voter on the FOMC this year, said it will likely be appropriate to keep policy rates at the current level for some time, emphasizing inflation. We heard something similar from Raphael Bostic of the Atlanta Fed, not a voter and someone who's going to retire, but nonetheless, there is a feeling that maybe there is a credibility issue on the Fed if inflation does remain above its 2% target for an even longer time going forward.
If you're looking to break the deadlock, the gridlock on the FOMC right now, you need the data to convert the holdouts. And based on what we heard from the press secretary yesterday, we're not going to get it. Both CPI and payrolls for the month of October.
A lot of people are looking for more clarity on exactly what's behind that statement by the White House press secretary, Caroline Leavitt. Some people saying Omar Sharif, for example, of Inflation Insights coming out last night and saying, frankly, I would take the White House's statement with a large grain of salt. I don't know where they're getting this information. We need to actually hear from the Bureau of Labor Statistics. That said, even if we do get this data, it is going to be so messy based on the absence of collectors of this data in real time.
We've got very little experience of handling all of this. The government doesn't have experience handling all of this. Let them get back into the seat, put out a schedule, work out what the BLS is going to do over the next month or so. Between now and then, the president's doubling down on this affordability push. You saw it there. As he reopens the government, we want to make America affordable again. That's where the focus is. The Treasury Secretary in the last 24 hours talking about $2,000 checks. The NEC Director coming out and discussing tariff relief. And then Bill Porty on houses. We've gone from 50-year mortgages to portable mortgages. That's where the effort is right now.
If you have a mortgage rate of 3.75%, congratulations. You can take that with you when you go to move. And basically, there is a feeling you need to reignite the housing market in order to get the economy going. And there is clearly a lot of uncertainty on how exactly to do that. The cost of living issues really front and center, especially after the elections. I was going to say midterm elections, but the midterm elections really put a spotlight on that. This is going to be the deciding factor going forward. You're going to see more of this. The question is, what's actually going to make it through to policy that could potentially change market activity as well?
Very close to all-time highs on the S&P 500 at the close yesterday. 4 days without losses this morning, pulling back by about 0.1%. Coming up this hour, we'll catch up with Keith Lerner of Truist as stocks look to add to 4 days of gains. Kona Haque of ED&F Man as the White House looks at tariff relief on food. And Nela Richardson of ADP on an economy flying blind after a month of lost data. We begin this hour with stocks a little changed as the US emerges from its longest ever government shutdown. Keith Lerner of Truist writing the S&P 500 bull market just marked its third anniversary and delivered the sixth strongest 6-month rebound in history. As we enter the final 2 months of the year, history is on a bull's side. Keith joins us now for more. Keith, good morning.
Good morning. Great to be here.
Great to see you. What are the tailwinds that you're so confident about right now?
Well, I think the main thing up front, I think this bull market deserves the benefit of the doubt. And we have all these carousel of concerns. As one concern recedes, we have another one to talk about, which makes it interesting. But the North Star of this bull market has been simple. It's been profits, in our view. And those profit trends are still moving higher. Forward 12-month estimates for the S&P are moving higher. But they're also moving higher for the average stock. They're moving higher for the small caps as well. And we also have a global bull market. It's not just the S&P. We have 90% of global markets in uptrends. And we're seeing the EFI make a fresh 52-week high. Emerging markets make 52-week highs. And then even as we get some jitter, some kind of uncomfortable, some headlines around the tech trade, money's not leaving, it's rotating. And then lastly, this morning, look at the AAII sentiment this morning. It's up to 49% bearishness. That's the highest since May. And we're still, as we're talking this morning, the Dow's at an all-time high.
I've asked this question 50 different ways. Earnings are great. Jobs data is not. When does the jobs data start to matter to this market?
It's a good question. I mean, we all talk about, people are talking about the K-shaped economy. We talk about the two-speed economy and the two-speed stock market. So, in some point, when you think about it, profit margins can benefit from wage growth slowing, but at some point, you need that consumer spending to help the economy move forward. So I don't know the exact date, but I think that's part of the reason why you've seen more weakness in some of the consumer discretionary space, the retail space. But we also have to remember the large cap market in particular is not driven by the low end consumer.
Well, and frankly, I mean, we've got Kevin Gordon coming on later, and I love his comment in a note where he said we're transitioning from a vibe session to a vibe-pression, and how there seems to be this increasingly negative view of the economy, but it has not translated into what people actually do. Retail therapy seems to be the solution to everything. So at what point do you just ignore this and take a look at what companies are saying, whether it's the airlines, whether it's the retailers, especially on the high end, consumers are still spending?
And that's right. And we're seeing it still even in the credit data that we follow also. So you're right. I mean, if you look at the headlines, look at consumer sentiment. We just had sentiment really just at really low levels. But when you test that out from a stock market perspective, a year later, the market tends to be up in a meaningful way. So I don't want to dismiss it because it is a two-tiered economy, two-tiered market. But big picture, if you're investing in the S&P 500, you're investing in these tech stocks. And as I mentioned, even globally, we're seeing some good activity as well. So when that turning point is, it's hard to say. But in the first quarter, we will see a little bit of a boost with some of the tax refunds. We're going to see maybe hopefully more clarity on the tariff side and maybe some more incentives on the business side. So I do think we'll see a little bit of an uptick. Maybe on the margin, people feel a little bit better.
Is it going to be inflationary? And this is really what Fed officials are grappling with. And honestly, I don't envy them, given the fact that they're grappling between potentially allowing inflation to become unmoored or causing permanent scarring to the labor market. How much can they really cut if you do get that boost to consumption in the early part of next year?
Yeah, it's a good question. It's a tricky situation for them. There's a lot of these different cross currents. But I will say there are maybe a little bit of an uptick because of the AI spending, because of the tariffs. But on the other side, we do have wages cooling somewhat. We have oil prices in the 60s. And what we led the program with was housing. Housing prices are softening as well. So that doesn't seem to me like a runaway inflation environment as a whole. And I'd also say, we still think the Fed ultimately moves towards 3% on the Fed funds by the end of next year. Whether they do it in December or January, I think people kind of over-fixate on that. We also have to remember that, on the way up, the economy was somewhat less interest rate sensitive, and it may be a little bit less interest rate sensitive as they cut. So I don't think that's the most important thing by far for the markets. Do
tax rebates change your outlook? $2,000 checks?
I think what it does on the margin is it lifts up maybe a slight uptick on GDP. Is it a game changer? No, but I mean, that's one of our main theses as we move into next year is getting a little bit more clarity and having a slight uptick in the overall economy. And, those tax stimulus checks do help out on the margin.
It's the focus of the White House. You can feel the shift.
Yeah.
It's all about affordability right now. The president said it almost directly yesterday, following the reopening of the government shutdown. So when you look out to 2026 and you've got a very narrow, concentrated equity market and a consumer that's been struggling and a president determined to do something about it going into the midterms next year, is that going to be the trade for next year?
Well, a lot of the question right now is, do we move out of tech? And we're still sticking with tech. I'm waiting for confirmation on some of the things we look at, relative price trends, relative earning trends, to go into this broadening trade. We have to remember, we came into this year, and what was the big theme? It was the broadening theme. It hasn't worked out. In fact, part of even the movement over the last couple of days, the rotation back there, is because they've underperformed so much. So the rubber band got stretched too much. So I think there's a case to be made for the broadening story again next year because of the uptick, because of the Fed still cutting rates, and we've had such outperformance by tech. But I also look back at different cycles. I look back at the 90s, I look back on the 2000s, and the leaders of bull markets tend to lead to the end. Doesn't mean there's not some intermittent mean reversion periods, but tech was the leader until March of 2000, and emerging markets were the leader into 2007. So I expect, even though there's these worries and these concerns, I think tech will ultimately still lead. If you believe you're in a bull market, I think ultimately tech has to participate and likely lead, even if there's some bouts of underperformance.
How much is this for tech, heads I win, tails you lose, in the sense that either they do really well and they continue to boom and the Fed's cutting rates because the rest of the world's not doing so well. And so then they continue to boom even more because there's more cash looking to go to work. Or, the whole world gets better and adapts to some sort of AI paradigm, and they also benefit. So how much is that the reason why it's sort of, in some ways, the riskier free bet for a lot of people in their portfolios?
Well, I think what happens with all these macro cross currents, the news headlines from day to day, you see these kind of short-term rotations into other areas, and then when people feel uncomfortable, where they go right back to tech. So, but you raise a good point too. One of the main questions I'm getting today is, are we in a tech bubble? And the other thing to keep in mind, going back with the Fed, is the Fed was raising rates in the late 90s, 2000. We're not doing that. We're still on a trajectory of actually moving lower. So I think I'd like to see a broadening. I'd like to see not a two-speed economy. I think most of us would like to see that as well. But I think you're right. I think if things slow down, money moves back to tech. And if the Fed cuts rates, people still stick with tech because of the financing side and the secular growth.
If the Fed is cutting in the face of inflation that has remained above the 2% target for more than 5 years, does that mean you should invest in the rest of the world and not necessarily the U.S.?
We're still Team USA. We've been Team USA for a long time. I think, we did last fall, we increased our exposure to EM, we increased our exposure to international developed. And I think a lot of times people just think about, hey, it has to be either or. And I say there's both with a bias. And our bias is still with the US. We still think that's the innovation. And what we also look at is, when we look at over the last decade of international underperformance, you can overlay that with earning trends. And the earnings momentum for the U.S. has been stronger that whole time. So what we're looking for to really say it's time to go even heavier into the international markets is to see those earning trends move up. We have seen better price action. Valuations are cheap. Sentiment has been negative coming into this year. But we still haven't seen the earnings. Now, EM, emerging markets, is more of a tech play relative to, say, the EFI, which is more of the kind of cyclical financials, industrials, and things of that nature.
Keith, this was good. You're going to stick with us, I'm pleased to say. Keith Lerner of Truist. Bramo describing a bull thesis. Ultimately, for the equity market, the things the stock market cares about right now have been great. Earnings. The things the Fed cares about haven't. Jobs. And that means you get the earnings, the profits, and you get the rate cuts.
This is really the underlying bet. I just wonder how much the ongoing bull market of 15 to 20% gains in 2026 for some overlying equity indexes, as we heard from Rick Reeder yesterday, how much that is predicated on a series of rate cuts that at least Fed officials who are being vocal aren't necessarily fully behind. Are people ignoring them completely and saying 2026 is a new story? Yeah, right. Let's see if that actually carries through.
I think May 2026 might be a new story.
I think rapidly it's becoming a new story. And some people are saying, watch what they do, not what they say. They're going to talk hawkish, then they're going to cut and basically try to jawbone the dollar into not losing too much value.
Some pushback going into the December 10th meeting. Equities this morning just about unchanged with an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. Well, the longest government shutdown in U.S. history has come to an end after President Trump signed an interim spending package. The 43-day shutdown halted food aid to millions of people, cancelled thousands of flights, and forced federal workers to go unpaid for more than a month. The government is now funded through the end of January, when prospects of another shutdown fight remain. Well, the shutdown may be over, but the White House is warning that October's economic data, including key readings on jobs and inflation, will likely never be released. Press Secretary Caroline Leavitt telling reporters that data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period. Chinese e-commerce giant Alibaba is overhauling its mobile AI app to resemble OpenAI's ChatGPT. Alibaba plans to rename the app Qwen in the coming months and add agentic AI features to support shopping on its platforms. Sources telling us here at Bloomberg that the end goal is to try and make Qwen a fully functioning AI agent. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later this hour. Up next on the programme, rebooting the government.
With my signature, the federal government will now resume normal operations. I just want to tell the American people you should not forget this when we come up to midterms.
That conversation up next with Bloomberg's Jack Fitzpatrick, live from New York City this morning. Good morning. $40 points away from all-time highs at the close yesterday. The S&P 500 this morning just about unchanged. The bias is still to buy on every single dip. UBS saying policy easing Robust corporate profits, strong AI spending, they've been the key market drivers. They should continue to support this equity rally.
Which is the reason why a lot of people are expecting there's going to be a chase into year end. Everyone who's missed their bogey, looking at the NASDAQ up more than 21% so far year to date, guess what? They are probably underperforming if they have been cautious, which means, guess what? They're probably going to go all in. Michael Burry is sort of the key tell. He might be right about a bubble in 2 years, but right now we're reporting that he has deregistered his hedge fund.
Interesting. Is that just crossed?
Well, he was talking about his hedge fund was deregistered according to SEC filings because he was early to this whole trade, which is very parallel to what happened during the 2007-2008. It just highlights how if you've been bearish, well, Dan Ives will tell you just how much they have been hurting and the reason why a lot of people are getting scared out of those positions.
The earnings story so far has been pretty decent. The policy easing story getting a little bit more complicated. In the bond market, the 2-year bond yield higher by 2 basis points at the moment, 10's up by a single basis point, 2's around 360, 10's around 4%. Under surveillance this morning, rebooting the government.
With my signature, the federal government will now resume normal operations. They had to do it the hard way. They look very bad, the Democrats do. I just want to tell the American people you should not forget this when we come up to midterms and other things. Don't forget what they've done to our country. We'll work on something having to do with health care. We can do a lot better. We can do great.
So here's the latest this morning. President Donald Trump officially signing an end to the longest U.S. government shutdown in history. Normal operations still potentially weeks away as Washington now faces a 6-week backlog. Bloomberg's Jack Fitzpatrick joins us now for more. Jack, can you describe what happens after the president signs that document? What happens next in Washington?
The first thing that happens is they have to call people back to work, and they have done that. So we need to see how many federal workers actually show up today, agency by agency, because this was not official until pretty late last night. The issue with federal workers not being paid has stretched on for so long that, again, this is agency by agency, tough to predict, but you certainly have a number of people leaning on sick time or vacation time to not show up when they were not being paid to do their jobs. So over the next few days at least, we're going to see, especially at agencies like the FAA and things that need to ramp up quickly, how quickly can they get everybody back in? The official plans for agencies to ramp up their operations call for quick action. It's not supposed to take weeks to work through a backlog, but the main impediment to getting things moving is that you have had people sitting at home because they were legally not allowed to work, or people not being paid when they were working, and you get a bit of a morale issue and people using their time off to either work a second job or just not show up to a job where they're not getting paid. So by early next week, we should know more about how agencies are ramping things up, how much rust they have to shake off. But it certainly does take some effort after the president's pen hits paper. One
government body this market is very focused on, Jack, is the BLS. The market bias, I would say the bias amongst economists, consensus if you will, they expected to see the September payrolls report very quickly. Then over the next few weeks or so, they expected to see the October payrolls report. And there was a question mark around CPI. Perhaps we'd never get it. Jack, the press secretary yesterday, October CPI and the jobs report will likely never be released. Jack, what do we know about that?
That is one area where there's a lot of latitude given to the White House. This is a shutdown that has tested the limits of how many decisions the executive branch can make on its own. And the details of pushing President Trump to release BLS data, economic data overall, was not written into this measure to fund the government. This is an area where there's a lot of latitude, and there are, in a legal capacity, not a lot of people pushing the president to release more data. There may be pressure to release more data. There's a lot of interest in it. But this is one area where over a 6-week shutdown, the president has to make decisions and gets to make a lot of decisions about how he manages things. So people who are frustrated with that in a legal sense may be out of luck because there's no directive from Congress telling him what he has to do. So it was surprising to hear the breadth of what's not going to be released from October from the White House press secretary, but there's not a lot of legal pushback or recourse for that.
Jack, just quickly, are you suggesting this is a choice? They actually have a choice to release the data or not?
Well, they've raised issues with the collection of the data, so I'm not saying that specifically just releasing it is a choice in its own, because they've got to manage employees and the operations of the BLS. But this is a matter of latitude for the executive branch, where there's not a law saying during the shutdown, here's exactly what you have to do. It's a choice that I think has played out over 6 weeks, and not just a choice on its own, whether to release data that they feel is proper. The description from the White House is they have had issues putting this together during the limitations they faced during the shutdown.
Got it, Jack. Thank you, sir. Jack Fitzpatrick down in Washington, D.C. With us here in New York, still around the table, Keith Lerner of Truist. Keith, can we just go through the data? What were you expecting to see, and how quickly were you expecting to see it?
I don't know that I had expectations when it was going to come through. It's a cloudy period. I'm our head of economics, I feel bad for him every day, even though he had a little bit of a vacation. And for me and for what we do, I mean, I just go back to profits. I'm focused on what the companies are saying, which tends to be more forward-looking anyway. So, and we also have to remember, I'd rather have data, but we also had jobs numbers early this year that were revised down by 900,000. So we all want the data. It's still the gold standard. It makes it cloudy, but I think we still have enough information from these private sources, along with what companies are telling us today, to say that the economy is still kind of muddling along. And then we also know some of the factors that we talked about next year, why there should be potentially a little bit of an uptick in our view. And then, we've talked a lot about the Fed. Maybe this clouds their decision as well. I don't think the Fed is the most important thing for this bull market to continue. I think it's probably more important for the rotation trade that the Fed continues to cut rates and we move towards that 3%. On the tech side, it's not the main driver. So, all in all, we'll get through this, and 3 or 4 months we'll be talking about something else. Maybe we'll be talking about the midterm elections by then, which will be coming as the main headline in 2026.
Well, midterm elections are going to be determined by the economy, and the economy has seemed increasingly divorced from corporate earnings, which you've talked about. At what point is that unsustainable?
Yeah, it's going back to what we talked about earlier. I think something else we have to think about too is we focus a lot about job growth, but we still have almost somewhere around 160 million people working. So I think what's also important, not just the monthly jobs number, is wage growth staying above inflation, and right now it is. So as long as we can continue that happening, and we have those folks, that 160 million people working, the consumer can still move forward. Maybe not at the pace, but we still have this kind of, it's if you don't have a job, it's difficult. Some of the college kids we're seeing not getting a job, it's difficult. So that I think that divergence is likely to persist, especially as you throw on AI on top of that.
Just real quick here, going forward, what's more important to hedge against, inflation or a slowdown?
I think a slowdown. I know our base case is for those reasons that we see a little bit of an uptick, but the labor market has been somewhat soft. And I mentioned already, we are seeing some of those other factors like housing, oil prices are somewhat down. And even though wage growth is above inflation, wage growth is slowing. So, and that can change quickly. So I would say that the hedge against would be the slower economy. And that's why maybe also, you've seen a little bit of rotation. Maybe it's more specific, but some healthcare. What I'd be looking for, too, to say that the market's actually concerned about a slowdown would be things like consumer staples starting to do better. We're not seeing that as of yet, but that's what we'll be watching early into the new year.
Keith, thanks for being here.
Great to be with you.
As always, thank you, sir. Keith Lerner there of Truist. I think that's the debate across December 9th and December 10th for this Federal Reserve. What are you more concerned about? Which side of the mandate?
And what if the answer is yes? Right? This is sort of what we talked about maybe 12 months ago, the idea of a stagflationary tilt. But what happens if you do see prices go up, particularly tied to some of these data centers and energy costs, albeit energy right now, not necessarily surging when it comes to oil prices, but these are some of the conundrums that they're facing off with.
Stocks so far this morning, just a little bit softer. We're down by about 0.1% on the S&P 500. Coming up next, we'll catch up with Kona Haque of ED&F Man as the White House looks to cut the price of food. Plus, Yahira has your morning movers. Cisco rising on an upbeat sales forecast. That name is up by close to 7%. 4 days, no losses on the S&P 500, the longest stretch so far this month for November. Equities this morning down just a touch. We're down by 0.2% on the S&P 500. On the Nasdaq 100, negative by close to 0.2. In the bond market, a big focus on the front end of the yield curve. What are they going to do at the Federal Reserve on December 10th? There's a massive divide right now. And the hawks are making more and more noise about what they're not going to do in the middle of December. Their focus appears to be on inflation. That's where the urgency is for the likes of Raphael Bostic of the Atlanta Fed.
Yeah, Raphael Bostic said that moving policy lower risks, feeding the inflation beast, and talking about how the preeminent concern really is bringing down the price increases that people have experienced. We also heard the same from Boston Fed President Susan Collins. At what point do they represent the mainstream, and at what point are they the fringes that will be overwhelmed by the Stephen Myrons and some of the other doves who would like to see rates a whole lot lower?
Bond yields this morning just a bit higher by 2 or 3 basis points on 10s, close to 4.1%. Some movers this morning. Check out Cisco. Record high back on March 31, 2000 was $77 at the close. Check it out in the pre-market. Here's Yahara with more. Hey, Yahara.
Hi, John. Yeah, we are seeing Cisco shares surging this morning, up nearly 7% in the pre-market after it lifted its 2026 outlook, a sign that it's making headway in capturing more of that booming AI spend. That's thanks to a partnership with NVIDIA. And as CEO Chuck Robbins put it, surging demand for safe AI networking. It now expects revenue to hit up to $61 billion in the fiscal year ending in July. That was above analyst estimates. Meanwhile, moving on to Alibaba ADRs, they are rising nearly or 4.5% in the pre-market on our reporting that it's preparing a major overhaul of its flagship AI app. It will rename it Qwen, and the goal is to make it resemble OpenAI's ChatGPT more closely. It also plans to load it with shopping features tied to Alibaba's massive e-commerce platforms as it makes a big bet on making money off its consumer-facing AI services. And we end on Flutter Entertainment. It has now pared some of its earlier losses down about 1.5% on weak results. But the real headline is it's getting into the red-hot predictions market, trying to compete with fast-growing rivals like Kalshi and Polymarket. This will also give FanDuel a way to reach states where sports betting isn't legal, since prediction markets fall under a different set of federal rules. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, the longest U.S. government shutdown is over. President Donald Trump signing legislation funding operations through the end of January. Thousands of federal workers returning to work today for the first time since October 1st. Elsewhere, the White House warning October's economic data may never be released due to the shutdown. Press Secretary Caroline Leavitt telling reporters, quote, economic data release will be permanently impaired, leaving our policymakers at the Fed flying blind. And finally, President Donald Trump pushing for affordability, signaling the White House will cut tariffs to tackle the rising costs of food. The administration also proposing a $2,000 subsidy for most Americans, and portable mortgages in the mix as well.
Yeah, this is the new push when it comes to mortgages, just simply because the 50-year debt seemed to be dead in the water with a lot of the mortgage strategists and investors that we spoke to. At the same time, you have to wonder, $2,000 checks, portable mortgages, if it's not portable mortgages, meaning that you can take your 3.5% rate with you if you buy a new home. Unclear exactly what the mechanism, the legal mechanism is going to be to do this. Nonetheless, you have to imagine it's all leading to more stimulus, which raises two questions. One, how much does this affect inflation and growth? And two, what does this do to the deficit? And at what point does the market kind of start to analyze this?
This is the framework for all of this. Profits are right up here. Earnings are right up there. Jobs growth is right down here. And that gap in between is where all the drama is. That's fertile ground for populist politics over the next 12 months or so. This is going to be the focus, not just for the politicians in the White House, but also on the other side of the aisle going into the midterms.
Which is the reason why when you look at the Committee for a Responsible Federal Budget, they immediately came out with something saying that if you add that $2,000 tariff relief to individuals, that could cost $600 billion in terms of the annual fiscal deficit, the drag on the budget. You start to add this up and you start wondering at what point will bond vigilantes start screaming again? Will they reemerge? Will this be an issue? How much will this actually be more rhetoric than it is actual policy? These are the things that are going to shape early next year, and it will shape. The fiscal is always underestimated when it comes to how much strength it gives to the underlying data.
We haven't had a responsible budget since the 90s, have we? It's been that long. We're still waiting for the vigilantes to bite.
I think that a lot of people on the Committee for a Responsible Federal Budget are engaging in, SSRIs.
10-year bond yield's very, very close to 4% this morning. Let's stick with cost and affordability. The White House signaling that tariff relief is coming.
I think that one of the things that people have been talking about just the last few days is thinking about changing tariffs for foodstuffs and things. The tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space.
So White House officials saying the administration may soon cut levies on imported foods like coffee and bananas. Kona Haque covers commodities for ED&F Man and writes the following. Much will depend on which origins Trump will reduce tariffs on and by how much. Kona joins us now for more. Kona, I imagine the focus is on things like Brazil, like Colombia. Is that right?
Correct, yeah. So Brazil has basically been slapped on with a 50% tariff rate. Brazil accounts for 30% of all of USA coffee imports. Another 20% comes from the likes of Colombia, where there's a 10% tariff, and another small percentage comes from Vietnam, again, about a 19% tariff. So these are huge increases at a time when global coffee prices were already on the ascent because of a shortage globally. So, yeah, the US roaster, the US coffee consumer has definitely been feeling the brunt of these rising prices.
Kona, that supply coming from those countries, let's take Brazil, for example. Have they found other buyers? Surely they're not just sitting on excess supply in a country, in an economy right now that's starved of supply. Have they found extra buyers? And what does it mean even if we do reduce tariffs on those countries now?
Yeah, no, so Brazil has not been sitting watching. At the moment, we're still in a global supply demand deficit. So there is actually just about a little bit more demand than there is in global supply, meaning Brazil has no shortage of consumers. So Europe, other countries, Asia have definitely been upping their increase in terms of Brazilian coffee. So anything that they couldn't sell to the USA because of the tariffs have definitely found homes elsewhere. Now, the thing is, when and if Brazil the tariffs are lifted off from Brazil, what happens? Will the US roaster automatically start buying from Brazil? Will there be enough left from Brazil? This year, Brazil will have had a very small crop. So, it's tricky in terms of how much will still be available for them to buy. That might lead to differentials, the cash price over the New York price to have to rally in order to get that out. New York Exchange Warehouse certified stocks are at 1-year lows. So this is all stuff that it's the reason why we saw prices go up at the first time when back in August those tariffs were put in place. So yeah, we saw a bit of a relief rally yesterday, a 5% drop in prices in the New York exchanges. And I think from here there's going to be some potential relief, but I think before you know it, you're going to run into some resistance because ultimately there isn't enough coffee to go around. We kind of need a big crop out of Brazil, hopefully next year, before we can start seeing more sustainable supply comforts.
This is not the conversation we want to be having at 6:37 a.m. in New York. The idea that coffee is in short supply and you won't be able to get some. So good luck. I just wonder how much some of the producers are incentivized to actually produce more versus just say, look, there was a structural issue, then tariffs came on, we've got to jack up prices a lot, and guess what? You need your coffee hit, so you're going to have to pay it.
So the US roaster, they've been lucky in the sense that they found a very resilient consumer. US consumers have not necessarily been cutting back coffee consumption. They've been trading down from out-of-home consumption to at-home consumption. And within that in-home consumption has moved away from the higher quality coffees to maybe the private labels, for example. So a shift from Arabica to Robusta. So you're seeing all of those kind of trading downs. But the price inelasticity of consumption has actually been pretty strong. The question is, margins get squeezed. If those US roasters are trying to pass on the tariff costs, how much more can they continue to pass on to the consumer? Yes, they've been resilient, but at some point they want to make sure that they have market share amongst other products on the supermarket shelf, right? So it's been a tough time for them, and you just have to look at some of the big roasters, the listed companies out there. They've not performed very well. So I think the relief will start to come. Globally, we have had a shortage. There's been multiple droughts in Brazil. Vietnam is on the cusp of a pretty big crop, so that should provide some robuster variety relief there. But ultimately, we need continuous good crop after good crop for us to come out of this multi-year deficit.
Aside from just coffee, more broadly in the agricultural space, how much have the price increases of late been tied to tariffs versus some of these environmental disruptions and other exogenous events?
Exogenous events. The supply-demand fundamentals have definitely been the biggest driver. But the tariffs have not helped because it just adds another layer of uncertainty. It causes a scramble for when you have one of the biggest producers suddenly kind of out of action because of this tariff. Then they start looking for other origins where they can get hold of it. So you're scrambling for whichever origin you can get hold of your foodstuff from, and that inevitably causes price increases. So you've definitely seen a bit of that. Initially, the price transfer down to the chain was not as strong because they used stocks that was built up before the tariffs came along. But as those stocks started to dry up, then inevitably there was questions of, okay, do we pass that cost on, or do we keep some margin, or do we squeeze our margins? Those are the kind of questions which might have protected the consumer a little bit, but there's only so much time you can do that before things start getting really, really testy. And I think these tariff reduction talks are coming at a very good time.
Kona, thanks for the update. I think a lot of people waking up this morning agree with you. Kona Haque there of ED&F Man. Just getting some numbers from the Walt Disney Company just crossing moments ago. Disney fourth quarter adjusted EPS coming in at $1.11, the estimate $1.07. Disney seeing double-digit adjusted EPS growth for 2026. The stock is down by a little more than 2% briefly. Negative territory so far this morning off the back of these results. The focus, Lisa, appears to be on expenses.
Yeah, the fact that it really has picked up and that quarterly revenue has been flat, operating income actually dropping. So definitely trying to look forward and saying that, yes, we are going to see exponential growth. But when you look into the numbers, there were a lot of disappointments when it comes to entertainment, when it comes to even sports revenues. And those are some of the details that people are going to be looking for when they parse through the earnings and listen to the earnings call.
The stock is down this morning in the pre-market by 2.5%. We'll come back to those numbers a little bit later. Let's get you an update on news worldwide with your Bloomberg brief. Here's Vonnie Quinn with more. Hey, Vonnie.
Hey, John. Thank you. Ukrainian President Volodymyr Zelensky says his country's survival depends on fresh funding from allies. Zelensky implored EU leaders to work through divisions on the use of frozen Russian assets.
We need their support, and if I hope, God bless, we will get this decision, but they will not have this decision. Of course, we together will find we have to find alternatives. It's a question of our surviving. That's why we need it very much.
The EU has postponed a decision on tapping into Russian assets until December. The International Energy Agency, or IEA, has increased its estimates for a record global oil surplus next year. The agency expects that world oil supplies will exceed demand in 2026 by just more than 4 million barrels a day, saying global balances are looking increasingly lopsided due to rising oil supply and relatively modest growth in demand. For the first time in 168 years, the U.S. is officially retiring a coin. The U.S. stamped the final set of pennies at the Philadelphia Mint on Wednesday, marking an end of the production of the smallest denomination of U.S. currency. This all after President Trump ordered its discontinuation. Don't worry if you find pennies lying around. It remains legal tender, and apparently over 300 billion remain in circulation. If I'm not wrong, that's $3 billion worth. That's your Bloomberg Brief, John.
Vonnie, thank you. Thanks for that. Up next on the programme, the Federal Reserve flying blind.
All of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
A conversation up next with Nela Richardson of ADP, live from New York City. You're watching Bloomberg TV. Disney in focus this morning. That stock is down by close to 3% in the pre-market. Earnings out just moments ago. EPS coming in at $1.11, the estimate $1.07. The company reiterating double-digit adjusted EPS growth for 2026. But 2 points of focus, I think, at the moment, Bramo. One is expenses, and for you, for growth.
Yeah, the question of revenue coming in light, and this is really the issue. Yes, some of the movies that they invested in were expensive, even the parks and the entertainment section, which really has been the bright spot for them. They need to put a lot of money into these sectors. At the same time, the revenue from things like Avatar, the latest Avatar movie, just haven't come in as strong as people expected. So a real question for Bob Iger, exactly how do you position to grow and increase your revenues at a time in a very competitive market, given the fact that you do need to spend so much on CapEx, you do need to spend so much on creating creatures from another planet.
We're down by more than 3% of the pre-market this morning on that name. The broader stock market down by about 0.2% on the S&P 500. The Nasdaq down by a similar amount. And the surveillance this morning, the Federal Reserve flying blind.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
So here's the latest this morning. The White House warning October's official reads on inflation and the labour market may never be released. Nela Richardson of ADP writing data suggests the labour market struggled to produce jobs consistently during the second half of October. Nela joins us now for more. Nela, good morning.
Good morning.
Let's just start with the economic data, the official economic data. Then we want to dig into what you're seeing in your data points. What's your understanding of what we will and won't get and how quickly we'll get it in the coming weeks and months?
Well, what it sounds like is it's going to take the gears of the data producing machine at the BLS and other agencies a little while to get going again. And that's to be expected after such a long shutdown. The definitive question is, will we get October data? It sounds like there's some suspicion around that. But also, will we get consistent revisions for September, which we've seen that those revisions, the second print, the third print, are actually more accurate in terms of the status of the labor market. So it's not just the October 1st print we'll miss the revisions along the way. And if November's the first time we get an official record from the government, that is a cloud of uncertainty that we are not used to seeing this far into the year. And let me just close with this, that retail sector, 20% of the revenues for retail is during this holiday season. So that jobs market, those seasonal hires are very important in setting the tone not only for the holiday season where a lot of stores are going to get their revenue, but all the way into the first quarter of 2026.
Have you got a real-time look of what's happening in that sector at the moment?
Yeah, we're looking at it closely, and we've seen that there is strength. In fact, in our monthly national employment report, we actually saw that retail and trade did produce a lot of jobs in the month of October. Now, since that time, we've rolled out a new weekly index, which is much more timely, the data much more volatile and preliminary, but it does suggest that this labor market is still struggling to keep pace with even a low bar of job gains. So we saw a decline, a cooling in the second half of October. We're going to keep watching that. We'll put out new numbers on Tuesday. But yeah, it's not a foregone conclusion that the labor market is in balance. In fact, it seems to be struggling on the weight of receding consumer demand.
How much are you getting requests to sort of extrapolate out what the non-farm payrolls would be in the absence of any data, right? How much do you see some correlation to the ADP series to what non-farm payrolls would or should have been?
Well, we were able to do this, and we put out a paper actually in collaboration with our collaborators at Stanford University, showing that for the first half of the year, the ADP numbers and the BLS estimates were within a few thousand of each other. Now, we were able to do that because we had all of the revisions from BLS for that first quarter. We can't do that until we get those revisions for the second half. But this year, they've been closely aligned. In fact, if you look back over the last year, these numbers, where the BLS estimate ends up after their third print and ADP's first print, are very closely aligned. And so I think what our data suggests is the direction and the trend of where actual employment will end up.
It also suggests that unemployment rates are going up if the job market and job creation isn't keeping pace. And I just wonder how sustainable that is with the economy growing at the pace that so many people think.
Lisa, that is a key question that will keep economists up all night long. It is, what is the new break even? Because even as we're seeing a softening in demand, perhaps from the employer, we're also seeing a reduction in supply, not just a lowering of immigration, but also the aging of the U.S. workforce. So put those two together, it may mean that we don't need as many jobs created every month to keep pace with the current level of unemployment. I think this is a moving target. I don't think it's like a unicorn in the forest. You're not going to be able to capture the break-even rate because so many things are changing, not just demographics, but AI is also having an impact, even in early career, which we've shown before. So putting all these megatrends together, it's going to be hard to capture what is the right number of jobs, right, to keep unemployment low.
So the Fed is guessing from meeting to meeting, and they've got to take another guess on December 10th. How difficult is that decision a month from now?
You know, I wouldn't call it a guess. I do think they have information. They have some data points. They are looking at private data just like other economists are. They have anecdotal data. But yes, they have to take a reasonable approach at a very difficult time between two pieces of their mandate. I think there's some confidence that inflation is above their target.
Yeah.
And there is some confidence that hiring has slowed tremendously since the beginning of the year. And then it's just a matter of perspective. And I guess that's where you punt a little bit.
How confident are they that we've slowed below the break-even rate?
I don't think there's any confidence of what that rate will be going forward. And even as soon as we find that rate, it's likely to change because it's so much structural change in the economy right now. There, in my view, that break-even rate is more mythical than it even usually is.
When we get to December 10th, that afternoon, and we get that statement, where do you see the committee ultimately leaning going into year-end?
From what we've heard so far, there seems to be a slight tilt towards a weakening labor market. But they'll have November data in hand from the BLS. And so that view could shift a little bit in a different direction. They also will have, I believe, some more indication of where inflation is going, even if it's anecdotal. So they'll have to cobble together a bunch of puzzle pieces and see which way to tilt. And I think what we'll see is a lot of divergence in that view.
Will faster growth early next year create more jobs?
You're assuming faster growth. And so in that question, yes, I think faster growth will create more jobs, but it depends on what growth that sector is coming from. Remember, the consumer has been resilient because the consumer has been employed. And so there has been this virtuous cycle that has led to U.S. exceptionalism. If there are any cracks in that, including cracks for low-skilled, low-paid workers, which are powering things like restaurants. I was just at a major restaurant convention, and they're worried about consumer demand. So if that consumer demand doesn't show up in certain key areas of the labor market, it's going to have a hampering effect on economic growth overall.
Can the labor market recover without the housing market?
It has. I mean, the housing market has been sidelined for a while. This is not new. This is decades long. House prices are too high. Housing is unaffordable in key parts of the country. It used to be an East Coast, West Coast housing affordability crisis. It's now even in the middle of the country. And so housing hasn't been a propeller of the labor market for quite some time. In fact, it's been replaced by hybrid and remote work, which allows people to live further away from their jobs. So what's interesting to me is how housing can be reconceived in this new economy. We can't go back 15, 20 years ago when housing led to dynamism. In fact, housing is actually second to new work structures like hybrid work.
Nela, always good to catch up. Thanks for being here. Nela Richardson there of ADP. We're light on data at the moment. Next week, on Tuesday, you'll get Home Depot, the day after Target, the day after Walmart. Retail in focus next week. Up next, we'll catch up with Johnston of Cantor Fitzgerald, Erika Najarian of UBS, Bloomberg's Geetha Raghunathan and Kristina Campmany of Invesco.
You're seeing a broadening beyond the kind of core AI names.
AI story is driving a decent portion of growth.
The AI power and the AI infrastructure basket still looks really, really compelling.
It's a vibe market, and it's all driven from sentiment for the most part.
I think equities are still going up 15 to 20% from where they are over the next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. 40 points away from all-time highs at a close on the S&P 500 in yesterday's session. This morning, we pulled back by 0.1%. Likewise on the Nasdaq. In the bond market, bond yields at the front end of the curve in focus. Big debate at the Federal Reserve about what they're going to do next. Yields up by 2 basis points, 358.89. Later on today, more Fed speak. More Fed speak going into the weekend. But next week, yes, we'll talk about Nvidia. Of course we will. But a bigger focus now on retail America. Home Depot Tuesday. On Wednesday, we'll hear from Target. On Walmart, we'll hear from them on Thursday. They're going to be the big three for next week.
How much are they able to pass prices along? How much are they seeing a consumer that very much is in the decline? And how much does that feed into the perceptions of some of the Fed speakers today, which include San Francisco Fed President Mary Daly, Minneapolis Fed President Neil Kashkari, St. Louis Fed President Alberto Muslim, and Cleveland Fed President Beth Hammack? Look, going forward, this is the conundrum. Is it the slowdown or is it the inflation story? Which is the Fed going to pick? And ultimately, retailers might hold the key.
The White House is very focused on affordability. Just piece by piece in the last 24 hours, $2,000 checks, tariff relief, portable mortgages. It's building into something bigger and bigger into next year.
The vibes aren't good, right? You could say that people are spending, and maybe it's because the upper income echelons are, especially with some of their stock gains that they've gotten so far this year. But people are not feeling great. We see that from survey after survey, and it's feeding into the political cycle. So does this mean that early next year we're going to get some policy prescription that potentially could offer a boost to growth? It seems to be one of the base cases for so many bulls who come on this show. Next year, watch fiscal stimulus, and guess what? We're going to play into it and ride the wave.
It's got to be a consideration for the committee of the Federal Reserve when they meet on December 9th and December 10th. So far this morning, 4 days without losses on the S&P 500 coming into Thursday morning. This morning, we're down by about 0.15% on the S&P. Coming up on the program, we'll catch up with Eric Johnston of Cantor Fitzgerald as investor optimism returns. Erika Najarian of UBS with President Trump tightening ties with Wall Street, and Kristina Campmany of Invesco as the Fed looks to emerge from the shutdown fog. We begin this hour with stocks little changed. Eric Johnston of Cantor Fitzgerald seeing the S&P 500 hitting 7K before year end. He writes sales growth is accelerating, margins are expanding, forward earnings estimates are rising and rising meaningfully. Eric joins us now for more. Eric, good morning.
Good morning.
Is that a recipe for a melt up into year end?
I think it is. I mean, the seasonal trends, are quite strong this year, especially when you've had a strong market into sort of November. November and December have historically been quite strong. And in particular, during the seasonally weak period of, July through October, when that's strong, the market's done very well in the last 2 months of the year. And as you said, the earnings tailwinds are significant. You had sales growth this quarter of 8%. Which is a pretty staggering number when you're not coming out of a recession, and margins are expanding, so you're getting this mid-teens earnings growth. A lot of it is, of course, highly correlated to this CapEx build-out, which we can talk about. But that earnings power is very strong. So I think things look good into year end.
Well, let's talk about it. How concentrated is it in one theme, one sector, and next week, Nvidia in one name?
Yes, so it's very concentrated. So it goes beyond, the top 10% are, 42% of the index, the top 10 names in the S&P 500. But it goes well beyond that. If you think about, some of the power names, if you think about Caterpillar, right? Names that aren't necessarily technology names, but are still, their earnings are still highly correlated to this big CapEx build out. And so that correlation, the S&P 500, we've been saying, is no longer a diversified equity index. So you have to kind of know what you own, and it's become much more sort of single stockish. And with that, you have higher risk, and then you also have higher potential return. But I think understanding what you own is super important because that correlation to this CapEx build out is super high.
How high risk is this when you have a Fed that's underwriting this?
So I think, one of the things that we've been saying is that we think inflation is going to stay sort of persistent because you have a Fed that is, lowering rates and a new Fed chair that's coming in that we think is going to, continue fairly aggressively to lower the rate outlook. So that should be good for risk assets. If you see a 2.5% to 3% type inflation rate and you don't have a Fed fighting it, that should be very positive for risk assets and margins.
It's something that you said in your recent notes that the Fed has given up on their 2% inflation target. How much do you think that bet is underpinning the risk rally that we've seen so far and a lot of people's bullish sentiment?
So I think it's a big part of it. Historically, the Fed has been targeting average inflation, which means you go from, if you go up to 2.5%, they're okay with 1.5%. If you think about since 2021, we've had 5 years above 2% inflation, and some of those years were 8-9%. So if you look at a trend chart of just absolute prices, we're about 25% above trend. And so the fact that they are now cutting in the face of 25% above trend is good for risk assets. Unfortunately, it's very bad, right, for the majority of consumers who are not necessarily benefiting from asset prices, but are paying the price of higher goods. And we're seeing that showing up in elections and so forth, and the affordability issue that you just mentioned. And so even if you come back to 2.5 or 2.25 or 2%, you're still so far above that rate.
Yeah,
but for risk assets, it's positive.
We hear this phrase that I think just sounds foreign to Main Street America, which is inflation expectations are anchored.
Right.
Do you see inflation expectations being anchored right now?
No. I mean, I think that the consumers have now become sort of accustomed to it because now we're going on 5 years. I don't think that consumers are seeing inflation accelerating, but the current pace enough is something that is troubling, and something that is likely concerning to most consumers.
Why are you bullish then on bonds? I mean, if this is the case, why wouldn't you be bearish, or is this just a bet that there's going to be some sort of yield curve control?
So it's the latter. So I think the backdrop for labor market is definitely part of the view, which is that I think labor is going to struggle for some period of time. Part of it is the supply issue. Part of it is companies cutting costs for margins, but part of it also is this AI backdrop, where even though a company may not be impacted today by AI, they can see out 1 to 2 years and are not necessarily making hires today that they think they may need to be replacing 1 to 2 years from now. But then you combine that with the new Fed chair. So we'll likely get the announcement probably within the next month. And we think that they're going to aggressively lower the Fed funds rate. Maybe it's 3%, maybe it's 2.75%. And then in addition, QE, and then the Treasury, once that Fed funds rate is lowered, moving the issuance to the front end, which should also help the deficit to GDP ratio. So we think there's a number of factors that are going to bring the whole curve down. And when we talk about
this is the issue. I mean, honestly, a lot of people were pointing to the New York Fed conference yesterday and some of the commentary about how they might have to start buying assets soon. To your point, it seems like this is very much on track. I just wonder why then we've seen a firming up of the dollar, right? Why this hasn't been expressed more in bearish dollar bets and, frankly, more bullish ones in gold.
Yes. So I think, as far as the dollar goes, there's been some demand elements that are, related to, stable coins, for example. And I think it's also just relative to what we're seeing in the rest of the world. And you're seeing, capital flows come into the U.S. A lot of it is, AI related. If you think about who are the AI winners across the globe, the U.S. is, the major winner. It's really the U.S. and it's China. And I think you're seeing the capital flows, into the U.S., which has helped the dollar.
What do you think will be the dominant force next year? Capital flows or just the concept of fiscal dominance gripping everyone and just a hard sell on the U.S. dollar?
Yeah, I think it's going to be a battle. I think a lot of it is going to be related to, does this CapEx cycle continue? We think it does. We don't think it's going to be a straight line. We think there's going to be scares, and there will be things that pop up that we are currently unaware of that won't make it a straight line. But we think ultimately that cycle, does continue. And when we think about, the fiscal backing, you're going to get refund checks that are going to be fairly high in the first quarter. The $2,000 that was just mentioned likely is coming. So there's going to be a fair amount of fiscal forces, and I think that there's a put that is out there that if things start to weaken, maybe there's a second check of $2,000, and there could be more.
You think we're going back to that?
I do. Yeah, I think that there is going to. I think there's this there's going to be this backdrop of stimulus that is going to support weakness that we see, any weakness that we see in the economy.
I'm pleased you and the team are thinking about the balance sheet more at the Federal Reserve, because I've been surprised how absent that has been from the conversation around the race to replace Fed Chair Jay Powell. When you speak to clients, are they engaging in a way that tells you they're at least thinking about it, leaning into that story for next year?
Yes, people are starting to think about QE more. John Williams talked about, not necessarily QE, but starting to potentially expand, the balance sheet. But I do think that it's going to come more into the dialogue in 26 that QE is likely coming, and trying to get, when you think about housing affordability, that's been in the news, recently in terms of different ideas coming out of the White House. Well, one of the biggest costs is your mortgage rate, and so getting those long end yields lower, I think is going to be super important, from the White House's perspective.
If you've been out of the market for a while and you came back and I said, welcome back, I'll tell you where GDP is and the unemployment rate. GDP's tracking somewhere close to 3, unemployment's somewhere in the low 4s. By the way, there's a conversation about the Fed doing QE next year and the White House sending out $2,000 checks. I know it's far more nuanced than those headline numbers because of the disparity beneath that, but it's kind of amazing that that's where we are into 26.
And if you look at where yields are on the 10-year, on the 30-year, you can be pretty surprised given the fact that inflation is where it is, and you're talking about this kind of backdrop. It raises a question how they're going to message it. And yesterday at that New York Fed conference, Roberto Perli, who runs the System Open Market account, came out and said, well, it looks like things are getting a little funky when it comes to some of the liquidity in markets, so we might have to start buying assets again. How much is going to be a liquidity story versus one of outright stimulus? How much is it balance sheet management versus outright QE? Watch the language, watch the rhetoric, and then watch what actually happens.
Eric, it's good to see you. Thanks for dropping by.
Thanks for having me.
Soon. Some interesting calls. Thank you, sir. Eric Johnston there of Cantor Fitzgerald. Let's give you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Disney shares falling after reporting sales for the fourth quarter that came in short of expectations. Disney's first quarter outlook for operating income also missing estimates, as they expect a slate of big budget films, including a new Avatar picture, will reduce earnings by $400 million. Be sure to tune into Bloomberg's Open Interest at 9 a.m. Eastern to hear Disney CFO Hugh Johnston break down the latest results. The longest government shutdown in U.S. history may be over, but the White House is warning that October's economic data, including key readings on jobs and inflation, likely never to be released. Press Secretary Caroline Levitt telling reporters that data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period. UK economic growth virtually grinding to a halt in the third quarter, with GDP rising just 0.1% compared with 0.3% in Q2. Modest growth in services in September were offset by a sharp decline in manufacturing, pound weaker against the dollar on the back of that data. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, breaking new ground.
I have with us not only the great political leaders, but the great business leaders of our country. They're standing right behind me. Today, we had the highest stock market price ever in all of the different markets. We're going to break new ground.
That conversation up next with Erika Najarian of UBS, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures pulling back by 0.2%. Slightly softer on the Nasdaq 100, we're down by 0.21. Under surveillance this morning, breaking new ground.
I have with us not only the great political leaders, but the great business leaders of our country. They're standing right behind me and right really alongside of me. And if we would have told them a year ago that we'd be having stock prices this high, none of them would have believed it. Today, we had the highest stock market price ever in all of the different markets. We're going to break new ground.
Just short of all-time highs at the close in yesterday's session, President Trump forging stronger ties with Wall Street, hosting top business executives at the White House, according to the Financial Times. Citadel founder Ken Griffin joining the dinner alongside CEOs including JP Morgan's Jamie Dimon. Bloomberg's Jack Fitzpatrick joins us now for more. Jack, do we know what they discussed yesterday evening?
Not exactly, no. They never announced, the White House never announced exactly what the agenda was, never gave a readout, and late before the dinner decided to not let cameras in for that brief first look. So this did turn out to be somewhat of a private event. There was the discussion openly about it afterwards from the president, and it is in a broader context of President Trump wanting to spotlight his focus on the economy. He understands that there are concerns about affordability, concerns about jobs, and as we get towards a midterm election next year in 2026 and an increasing focus on politics, he knows that he wants to sell the American people on stock market wins and what he's done for the economy. You heard a little bit about that in the discussions about a $2,000 stimulus check, which is not something he has gotten Congress to work on. So there's a broader context here to consider, but no, on the specifics, they've been fairly tight-lipped, and whether it was largely a matter of I wouldn't call it a publicity stunt because they didn't push for a lot of publicity, but this was something that the White House did not share a lot of details on, despite the fact that they want to put a spotlight on the president's focus on the economy.
Jack, thank you, sir. Jack Fitzpatrick down in Washington, D.C. Let's stick on banks. The Trump administration working towards deeper changes in banking regulations. Erika Najarian of UBS saying the scope and speed of regulatory reform appears underappreciated. Erika joins us now for more. Erika, good morning.
Morning.
What do you think we are underappreciating right now?
So I think for the first time, this didn't happen in the first Trump administration. This administration is actually untangling all the regulations that have been a web and that has been trapping capital. So, for example, in Trump 1.0, they really just focused on the regional banks. They did not unleash the trillionaire's balance sheet, so to speak. And the way post-global financial crisis regulations were really built is they had all these backstops. Okay, you look good on capital against risk-weighted assets. Well, we'll have a backstop to have capital against unrisk-weighted assets. And so what they're doing is they're saying, okay, here are all the blocks, all the traps for capital, whether it's a stress test, it's the leverage ratio, or, the GSIB surcharge, which is essentially a surcharge that punishes banks for being big. So if you're serving a growing economy, your capital charge could actually grow in perpetuity. So what they're saying is, let's adjust that, and it makes sense if the economy is going to be obviously a big focus, especially going into 2026. You need bank balance sheets for that.
It raises this question, what will the banks do with the extra leeway to lend?
Yeah, so that is a good question. And they all actually have different ways to deploy it, right? So, for example, we just heard from Bank of America. And Bank of America is going to deploy that capital to, rebuild a card business or, reaccelerate a card business and pay more attention to, their mass affluent business in Merrill. You have companies like Wells Fargo who are unshackled and are going to get bigger in terms of capital markets and get even bigger in corporate lending, right? And so there's different parts of it that's for the consumer, and there's different parts of it for Main Street businesses and Wall Street.
I guess that what I'm trying to get at is if this dinner, and we don't know what exactly was discussed at this dinner, but let's say it was about affordability and it was about the state of the economy, how much do the largest banks still extend a significant part of the credit to the lower tiers of the economy, to sort of this broader area that actually has been the ones that have been experiencing the pain?
That's a really good question. Look, the mortgage train had left pretty much a decade ago, right? I mean, the global financial crisis plus Dodd-Frank essentially disincentivized banks from being a big part of the mortgage business. What do they have on their balance sheets? Jumbo mortgages, right? Mortgages that have adjustable rates. So, you really need, affordability is about having more supply. Affordability is about what the ultimate long-term solution is for Fannie and Freddie, right? Affordability is going to be about, is there going to be a reopening of a private MBS market like we did, pre-GFC? The banks want nothing to do with it, not because they don't want to service their customers, but because Dodd-Frank had codified how difficult it is, to essentially
originate a mortgage for the regular American.
There's another piece of the story with banks that I think we need to talk about more, and it speaks to the social tension in the labour market at the moment. In an ideal world, they'd be hiring aggressively in a growing economy. What we've heard from Brian Moynihan of Bank of America and Jamie Dimon of JP Morgan recently is their ability to generate more and more revenue from each employee. What's your take on that? What's that going to look like in several years' time in a financial industry?
So I've been in the business for almost 25 years, and I feel like I never worked under a Wall Street where more with less wasn't the rule of thumb, right? So I never was there during the boom years. But look, I mean, if you think about what AI can do in terms of helping our junior staff be more efficient, and then they can convert their time into, something more client-facing and more sort of thought-producing rather than rote. I mean, it's pretty awesome, right? And so, as opposed to physically going through transcripts, all of a sudden you could be like, okay, what did Bank of America say over the past 24 quarters, and put it all down? I think that's pretty cool. And look, I mean, there is always going to be a war for top talent. I think there was a Wall Street Journal front page article maybe in September about the war for talent. And the same is kind of happening with commercial bankers, for example.
Is this the next leg, though, of the AI trade? Because the focus has been almost exclusively over the run-up to this year, at least, on the enablers, so the chips, the NVIDIAs of this world. Is this going to be the next leg of the trade, financial services, a bigger focus on that?
I'm not sure, because actually that's a great question. We did sit down with JP Morgan's chief data and analytics officer. And our sense is that AI is going to have more revenue impact than we think. So perhaps that's really the angle rather than cost, because you will need to put in some cost to enable the power of AI within a regulated industry.
Erika, it's good to see you. Thanks for being here.
Thank you.
Thanks for dropping by. Erika Najarian there of UBS on the banks, focused on the revenue they can generate in the years to come.
Yeah, and maybe also compared to the headcount and how the headcount is not growing. Look, Erika put it well. They always have been looking to do more with less. Is the capability now to do so much more with significantly less? And I think that that's what people are focused on. This is a seismic shift in terms of the capabilities potentially, and what we can actually do with that remains to be seen. There are so many economic bets hinged on that, a lot of valuation ones too.
That's the story the executives want to sell us, at least at the moment, from Bank of America last week and JP Morgan as well going forward. Some of those names have had a really great year through 2025. That's not what it felt like in early April, is it? We're in a very different place in the last 7 months. Things have changed rapidly.
Yeah, and it lasted for what, about 3 weeks? And then suddenly the vengeance of buying, not even, right? I mean, and then the buying just absolutely surged. It's interesting that we're talking about the likes of Cisco almost reaching the record high that it last reached in 2000. And this is because it's refabricating itself as an AI company. So it highlights how this really is the buzzword on both a thematic as well as a valuation standpoint.
Talk about lost decades.
Decades is correct.
The end of March in the year 2000, $77 a share at the close, and it's taken us all these years to get back to those levels. Amazing. Coming up on the program, Bloomberg's Geetha Raghunathan with Disney sales falling short of Wall Street estimates, plus Yahara has some morning movers. Dollar Tree in focus. That name down 3%. No real drama so far this morning, pulling back by just 0.16% on the S&P 500. On the Nasdaq 100, down by 0.2. Some underperformance on the small caps, the Russell. Lighter, softer, negative, down by 0.4. Switch on the board and get to the bond market. 2s, 10s and 30s shaping up as follows. This is your yield curve so far this morning. 2-year bond yield higher by 2 basis points. Likewise on 10s, your 10-year this morning, 4.09%. That's the setup this morning across stocks and bonds. Let's get you some single names, some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. Disney is bracing for a pricey start to the year, and that is hitting the stock this morning. Shares are down 3.75%. The studio is spending big on blockbusters like Zootopia 2 and its latest Avatar, and that is expected to weigh on first quarter results. It did see some bright spots, for example, in its parks and cruise division. Those are performing well. Plus, it did say that earnings are expected to grow in the double digits later that next year, but that not enough to impress investors this morning. Meanwhile, we are seeing Dollar Tree shares fall on a double downgrade by Goldman Sachs. Now it has the stock at a sell, saying that further upside from here gets harder, and they cite concerns around the lower income consumer, which Dollar Tree, of course, caters to, basically saying that the issue is that shoppers just aren't finding the same type of value as they used to at a Dollar Tree. And we end on Firefly Aerospace. Those shares are soaring more than 20% now in the pre-market. The company saying that it made some fixes and plans to get its Alpha rocket flying again by year end. That's after an explosion back in September. This is a company trying to make a name for itself in the commercial space race, even landing a spacecraft on the moon earlier this year. John?
Yahara, very cool. Thank you. Let's go to Dollar Tree. Dollar General. We can talk about all the dollar stores. These are curious companies because when they do well, we say things are bad. And when they do badly, then things must be really, really bad. And that's ultimately what Goldman Sachs is telling you so far this morning.
Yeah, they're also particularly hit and buffeted by some of the trends when it comes to tariffs and some of the goods from overseas. That was one of the ways that they got cheaper goods. So how do they offer cheaper goods at a time when you are seeing price increases of certain items? Also, a real question here, are other companies getting in on their game and actually trying to offer discounts and maybe are in a better position to do so because they are attracting both the more affluent consumer as well as the lower income? This is a story about specific names as much as it is macro stories.
Walmart and Target next week, the big two to focus on with regards to this story. We'll talk about that more in the coming days and the next week or so. That name of the pre-market down by 2 to 3%. On our radar this morning, the White House saying last month's key economic data is likely lost forever due to the government shutdown.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
So the news there was this bit, and jobs reports, because there was a question mark above CPI anyway, going into yesterday, and jobs reports for the month of October as well.
A lot of commentary coming from Wall Street saying they'll wait for the Bureau of Labor Statistics to confirm this. The Bureau of Labor Statistics is an independent agency that is codified by Congress, and a real lack of certainty around what the relationship is between the White House and the Bureau of Labor Statistics and whether the White House is reflecting an inability of the Bureau of Labor Statistics to put out this data. So still a lot of gray area, skepticism coming from Wall Street. Nonetheless, it highlights just what a fog we're going to be in.
How do you convert the holdouts of the Federal Reserve without the jobs data going into their December 10th meeting? We've heard from the Boston and Atlanta Fed presidents in the last 24 hours. They've both shared a hawkish stance, both Susan Collins and Raphael Bostic, saying they see inflation as a greater risk and they favour holding rates steady. For the bulk of the committee, and I say the bulk, for the one half of the committee that's worried about inflation and not worried about what's happening in the labour market, how do you convert them if you don't get the jobs number?
Do you have to?
Soon?
I mean, do you have to? Because Raphael Bostic is retiring, and he's going to not be there for 2027 when the Atlanta Fed gets a vote on the FOMC. And then, yes, Boston Fed President Susan Collins does have a vote, but others are actually very willing to cut rates. We've heard from others, including San Francisco Fed President Mary Daly, who's talked about a concern about hampering a labor market undergoing a dramatic transformational, technologically driven transformation. So this is a very difficult moment, and some voices maybe speak louder than others.
Well, one half of the committee very worried about the labour market, not concerned about what's happening with financial conditions. This is quite a notable name to be talking about if you lived through the late 90s in this market and the early 2000s. Cisco. Shares gaining following an earnings beat and a forecast boost. The company working to capture more AI spending, teaming up with NVIDIA to get more of an edge on chips and data centres. That stock trading at 79 in the pre-market.
Yeah, superseding the last record back in 2000, which really highlights, just to your point earlier, how much of a lost quarter century this really has been for the company. Why are they winning? And that is what a lot of people are looking at. And I mean, they actually have lagged behind some of the semiconductor stocks so far this year. They're actually put over the average with the gain in pre-market trading of futures. I'm curious, though, how much Cisco is actually the one to watch right now. They are instrumental in the average company being able to adapt to artificial intelligence. They're sort of the bridge between NVIDIA and the idea of how you practically put this into effect.
how much are these companies going to really be the tell about how much companies are really using artificial intelligence to become more efficient and actually have those gains broaden out?
Chuck Robbins getting it done over at Cisco. That name of the pre-market higher by 7.6%. Let's stick with some of the earnings so far this morning. The latest this morning coming from Disney. Shares falling short of expectations in fourth quarter expectations. Just missing those numbers this morning, posting a miss on revenue and operating income. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what jumped out for you?
Yeah, I think what jumped out to me, yes, a little bit of mixed results, as you pointed out, John. But I think what investors were really looking at was 2026 guidance. And while they did reaffirm their previous guidance of, double-digit EPS growth, I just don't think that's enough. I think they wanted more specificity. Yes, we know that, the park segment is going to grow profits by, high single digits. But again, I just don't think that was enough. The two big things that investors are looking in a quarter in and quarter out is the parks business and the streaming business, right? Those are the biggest sources of earnings power, of earnings potential at this company. And while they did guide to, again, pretty strong numbers, I think the street was looking for a little bit more.
Geetha, where do you think that little bit more can come from in the coming quarters?
I think both streaming and parks are a little bit underappreciated, John. So as you kind of look at, let's just take the parks business. This brings in about 55 to 60% of profits. So absolutely the biggest element of profits and revenue at the company. And really, if you look at 2026, there are just so many different drivers. You have 2 new cruise ships that are coming on board. We have this big ambitious plan, $60 billion in CapEx that Disney laid out over 10 years. So you have a whole host of new attractions that are coming, across. There were recent price increases. So all of those should help. I think the other big source, where we can see those earnings numbers go up pretty nicely, is going to be on the streaming side. So we just saw Disney take up some price increases. We saw actually pretty strong subscriber numbers at Disney Plus. I mean, people weren't expecting this, just kind of given the whole Jimmy Kimmel controversy and things like that. But still, we saw pretty good numbers. So I think, again, as they can keep taking up those price increases, as they keep bundling with ESPN Plus, with other different streamers, I think that could become a real source of earnings upside as well.
So it sounds like tickets are about $200 a day to go to Disney World at the high end. It's gone up significantly over the past few years. This has been one of the main drivers of revenues. How much higher can they take them?
I think they can keep taking them higher. And I say that because of 2 things that are happening, Lisa. So one thing is Disney is investing. So they are making the customer experience better and better. We've just seen a whole host of attractions that they've added, across Magic Kingdom, across the California Avengers campus. There's a whole world of Frozen that is, opened up in Hong Kong and Paris. So we're seeing all of these new attractions that they're adding consistently, and people are willing to pay for them. And the other thing is we've just generally seen this whole boom in the experience economy. People really want to go out and have all of these live experiences, whether they're concerts, whether they're theme parks, whether they're cruises, whether they're live sporting events. And so we're seeing that, make up a bigger and bigger share of the consumer wallet. And that is a good thing for Disney.
That's actually exactly where I was going to go, Geetha. How much is this a read on just general consumer appetite? And how much is this a structural shift in where people spend their money, especially post-pandemic, where the experience took preeminence over the products?
Yeah, so I think we've seen a really, really strong growth. So, the one number that we keep tracking for Disney, that we're tracking this for Universal at Comcast, is, per capita growth. And that has been really strong. So last quarter, they reported something like 8% per capita growth, which is one of the highest numbers that they've ever reported. I suspect it's going to be the same thing, this quarter as well. So we've kind of seen that underlying demand. People are willing to pay for experiences. They're adding, of course, whole new experiences. So we're seeing that they're, just look at the cruises. This is why Disney's making these investments. So you look at it pre-pandemic, they had 4 ships. By the end of 2026, they're going to have 8 ships. By the end of 2031, they're going to have 13 ships. So they are investing because people are going. So they're seeing the demand, which is kind of, speaks to, I think, why we're going to continue to see a lot of growth in the parks division.
Lisa, a Disney vacation stopped being accessible a long, long time ago. for the average American. It is so expensive.
Have you never been?
I've never been. I've seen the price.
It's absolutely, well, it's
I
not
don't need
just
to go
that.
to know the price. That's why I haven't been.
It's not
tens
just that.
of thousands of dollars to have a week there. It's ridiculous.
Yeah. And if you want to skip the line and you have a concierge service, you're basically paying for a new house. I mean,
Bonkers
essentially,
to take a family.
I'm looking right now at a Disney cruise for you just to see if I can provide some offerings that you're going to absolutely love. But to me, what's interesting is people are still paying it. That's still the driver. And it's not all of the very high income individuals. People will save up for these Disney experiences, and it highlights how much people have shifted their spending habits. And you see this across the board, which makes it very difficult to get an understanding of the broader consumer from some of the companies that traditionally have been more sort of tied to some sort of consumer cycle.
Disney down by about 4% at the pre-market. Geetha, just a final question for me on the Walt Disney Company and its Hulu, and whether they've really finished sort of finessing the user experience. When you go on Disney Plus at the moment, you see across the top, it'll say Disney, it'll say Hulu, it'll say ESPN. What are they going to do about all of that? What are they going to make this product look like?
They're going to keep refining it. So they're refining the recommendation engine. And this is what all of these companies are doing. We've seen, Netflix do this. Disney's obviously doing this in a big way. And John, just to your point about Hulu, they had their biggest jump in subscribers. They added almost 8 million subscribers. Of course, a lot of that was due to, their charter deal. But the user experience is going to be paramount going forward. They're integrating all their apps. And even as we kind of look at ESPN kind of going forward, we kind of think that they want to make it this one-stop shop for, sports streaming. And I think that's exactly what it's going to become. So Disney working really hard to kind of integrate all of these different streaming apps into a single spot.
I'm just going to say this from my perspective, Geetha, the worst algo out of all of the companies out there. They seem to never know what I want to watch, and I've always got to search for it.
Geetha was responding and saying this is the goal for Disney. This is what they are going to do because user experience, Jonathan Ferro's user experience is paramount.
It's so easy.
Yeah, well, it's true. And this is going to be a serious issue, especially because their sports revenue is not as high as some people had expected it. So to that point, maybe you're going to cut your subscription? I don't think so.
I don't think so.
Yeah, exactly.
No, unfortunately not. And that's the problem. That's why prices keep going up. We're not there yet. Geetha, thank you. Geetha Rakuten there of Bloomberg. The latest on Disney. That stock is down by close to 4%. With an update on stories worldwide this morning with your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Chinese e-commerce giant Alibaba is overhauling its mobile AI app to resemble OpenAI's ChatGPT in the coming months. Alibaba plans to rename the app Qwen and add agentic AI features to support shopping on its platforms. Sources telling us here at Bloomberg that the end goal is to try and make Qwen a fully functioning AI agent. The Supreme Court scheduled arguments on President Trump's effort to fire Federal Reserve Governor Lisa Cook for January 21st. Cook has remained on the job since late August when Trump said he would remove her over mortgage fraud allegations that she denies. The High Court will consider whether Trump can fire Cook while the legal fight moves forward. The U.S. government will aim to start lifting flight restrictions in about a week. The Transportation Department and FAA reduced domestic flights across 40 major airports during the government shutdown. Lisa asked Delta CEO Ed Bastian about those cuts yesterday.
How long will it take before we don't see any delays or any unexpected delays tied to the shutdown?
I think it'll happen pretty quickly. I think once people start getting paid, and I know Secretary Duffy is committed to getting those paychecks out right away. So over the next couple of days, I think you'll see things starting to turn to normal.
Bastian adding holiday bookings slowed as passengers were worried about getting stranded during Thanksgiving and Christmas. And that is your Bloomberg Brief. John.
Bonnie, thank you. Annmarie was offering to drive them, wasn't she?
Yeah,
but they weren't flying.
Yeah, evidently they stayed home instead. It seems like they're relieved over at Delta for not being a political football right now.
What was your takeaway yesterday?
My takeaway is that things were very strong heading into this. There was a real disruption when it came to bookings, etc. They talked about how this is a Super Bowl, though, Thanksgiving. I mean, Annmarie might be renting a truck to drive everybody to their relatives, but evidently most of them still want to fly.
This is a very busy period, to state the obvious, for the airlines. Up next on the program, the cost of the shutdown.
Our estimate of the White House is that each week that we were shut down is worth about $15 billion off of GDP. So I was kind of feeling good about a 3% quarter before the shutdown. So I guess that means that you think we'd be shooting in the sort of 1.5 to 2 range now.
Good to see Kevin Hassett on Bloomberg TV. Up next on the program, Kristina Campmany of Invesco. thought Bramo was bearish live on TV. Should hear some of it in the commercial break.
All right, let's move forward.
I'm going to move on.
I was actually completely honest. I'm wondering what banks are going to do with their money. If they have all this money, it's not a great time to invest, except for investing in AI to possibly replace humans eventually down the line. I don't think that's bearish. I think that's bullish. It's bullish for earnings.
It's what's on your mind in the commercial break. I'm with you. Thanks for sharing it.
Anytime.
Some people at home feel the same way. They don't stay up at night thinking about it in quite the same way, but they feel the same way sometimes.
Yeah, well, there are really fun things to think about.
All right, let's get to markets. Equities are down by 1/10% on the S&P 500. On the Nasdaq, down by a similar amount. Under surveillance this morning, the cost of the shutdown.
Our estimate of the White House is that each week that we were shut down is worth about $15 billion off of GDP. I think the Goldman guys have added all that up and guessed that it's between 1 and 1.5% reduction in the growth rate of GDP this quarter. So I was kind of feeling good about a 3% quarter before the shutdown. So I guess that means that you think we'd be shooting in the sort of 1.5 to 2 range now.
So here's the latest this morning. Bloomberg Economics estimating the shutdown will subtract 1.3 percentage points from fourth quarter GDP. The Federal Reserve now hoping to shake off the data fog ahead of their December meeting. Kristina Campmany of Invesco writing, we expect clarity on the calendar for US data flow within the few days coming out of a shutdown, but expect data to be noisy at best, with the potential for market buyers to discount data extremes. Kristina joins us now for more. Kristina, good morning.
Good morning. Thanks so much for having me in.
Some doubt about payrolls being released now, and not just CPI. What's your base case?
Look, I don't know if we get the data or not, but I think either way, we know that the data is going to be really noisy. So we finally will start getting data flow, but I think we have more murky water coming probably into year end. And there's a lot of questions of, do you get both payroll reports on the same day? And I think the extremes, exactly like we said, are going to be discounted. And I think we have to go back to what the story's been all year, that you've had really weak sentiment data that kept getting re-anchored by decent or hard tier 1 data. And then the breakdown came in the summer when you got the revisions to the labor market data and weakness. And now we've had no real data. So it's just been this very weak sentiment data. So where do we go from here? Do we have the hard data re-anchor? And I think that's like a really important path forward. And I think you look at the consumer too, even though sentiment data has been so weak, the consumer spending numbers and the credit card data numbers have still been robust. So you still have this bifurcation of like, well, which is it? You don't feel good, but you're still spending.
You're right to point it out in the summer. The start of August, that July jobs report changed the conversation. Coming out of the summer, we caught up with you, and consensus started to develop into the idea that the Federal Reserve was going to start an easing cycle. They went 25. They went 25. Is that now developing into a prolonged pause at the Federal Reserve?
So Powell clearly came back and pushed back aggressively on the market's pricing at the October press conference. And I appreciate wanting to have some kind of flexibility and not be priced over 100% for December. Like, that's reasonable from the Fed. For me, what I have a harder time with is even the pushbacks at the October meeting, and you've started to hear more noise and grumbling around the Fed. And I think probably a noisier Fed is here to stay, and you're going to hear like a wider range of voices. But for me, it's hard to say you supported one ease in September and you're going to dissent in October. We're talking about monetary policy that has long lags and is a blunt instrument. So easing 25, being okay with 25 but not 50 feels like a challenging one for me. So we've always kind of been in the camp of you deliver 75 to 100, similar to last year, and then you can sit on your hands and say, let's see how this actually feeds through the economy. So our base case is still that they can go in December.
Did you write a letter to the Kansas City Fed?
We did not. But there's so many moving parts. And I think the reality is they'll probably still be flying blind data-wise. And when you're flying blind, I don't think that means Powell talked about putting on the brakes or pausing. I don't think that means you like avert course and change the direction.
I think a lot of people agree with you. I mean, right now the pricing in Fed funds futures is more than 50% for that December rate cut. I just wonder why we're not seeing any kind of steepening in the yield curve, given the fact that probably early next year we are going to get some stimulus checks. We probably are going to get some fiscal efforts coming from Washington.
Yeah. So look, I think we've been in the camp to have a steeper yield curve for much of the year. And I think the frustrating part, we've like gone in bits and bouts of like, we've steepened, we've flattened it back, has been the long end for us. And you think about all of the fiscal dynamics in the U.S. and obviously the U.S. is the U.S. So it has that that benefit in markets, and it is the most robust, deepest market, so it has that benefit. But we're at the low end of yields in 10s and bonds, and I don't know that we're discounting or like fairly pricing in the tax policy risk. You're going to have stimulus next year. So do we need to, like, even if the Fed eases, do long end rates need to be lower? I don't think so because of where we are. Are we pricing in inflation risk? Inflation's kind of been sticky.
There's one argument that if you have the Fed that's cutting rates, people who've gotten accustomed to getting income on their cash are going to look for other places to get their income. And they're not necessarily going to go straight into equities. They're going to go into duration. Mm-hmm. And so they're going to lock in those yields, which will keep a lid on how high yields can go, regardless of the backdrop of the deficit and inflation and all of these other concerns. What's your take on that argument?
I think the argument about all-in yields, certainly for credit and front-end high-quality paper, like I think that's a real argument, and it exists out there. Even though as a rates person, it's a frustrating argument because you say, like, why not barbell and be in the front end in the U.S. in treasuries or in rate product and then out the curve? But I think that it's a different dynamic for 30 years. And I think that 30-year point globally, that steepening and all of the pressures there is a global phenomenon. Like, look at what's going on in 30-year JGBs and under the new government, this kind of combination of reflationary policy and a much weaker yen and it's like you're pushing on all of the limits and something's going to break. And I think we've learned this year that all of these markets are interconnected, and what goes with one will affect others. So
10-year bond yield's been a bit of a pain trade this year. Trades this morning at 4.09%, ended last year, last trading day of the year, 4.57. Yeah. That bond yield's lower, not higher on the year so far.
You know what we haven't mentioned yet today? $25 billion of 30-year notes coming out at 1 p.m. An auction today of 30-year notes. 6 months ago, that would have been exciting. Right now, people are like, there's plenty of demand coming in.
Are you suggesting it's not exciting anymore?
I think it's still exciting, but I think that other people are less excited about it. So I'm not going to beat the drum as much because, I don't feel like getting hate mail this early.
If you care, we should care.
Okay, well, I think people should care because ultimately this is a testament to how much people are actually looking at the global dynamic as well as the sort of potential buyers versus the inflation picture, which could potentially surprise the upside.
A lot of supply coming into credit as well at the same time.
And you look at the corporate supply, and a lot of it has been all of this AI-related, very long-dated issuance, which has been absorbed with ease. And like we talk about the credit market, I mean, credit spreads are very tight. So you have to sit there and say, like, what are the risks out there? Like, there's a lot of comparisons to, is this the 1990s tech bubble again? And there's many reasons that it's different, but everyone won't be a winner, right? So there has to be some choosiness about it.
Kristina, we've got to go. It's good to see you. Thanks for being here.
Thank
you. Kristina Campmany of Invesco. The third hour of Bloomberg Surveillance is coming up next.
You're seeing a broadening beyond the kind of core AI names.
The AI story is driving a decent portion of growth.
The AI power and the AI infrastructure basket still looks really, really compelling.
It's a vibe market, and it's all driven from sentiment for the most part.
I think equities are still going up 15 to 20% from where they are over the next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P, negative by 0.2, following 4 days without losses on the S&P 500. The longest stretch of the month so far. On the Nasdaq, we're down by about 0.2%. In the bond market, pretty stable. 2s, 10s and 30s. Yields a bit higher by a basis point or two. The 10-year still south of 4.1%. 2s at 3.58. Your week ahead and the next few days shaping up as follows. One thing not there, and we can talk about it now, $25 billion of 30-year bonds, which Lisa is very interested in later on this afternoon.
Well, it kind of goes to the heart of the dynamics we've been talking about. The idea that fiscal stimulus is increasingly going to come on the table. We're going to see an increase in the fiscal deficit, probably not with more issuance in the longer end necessarily. We did hear some from Treasury Secretary Scott Bessent on that. Nonetheless, how are people gaming out the inflation story? It seems like on the Fed, people are very worried about long-term inflation. It seems like in markets, not so much, at least by the recent price action. Do we see a reawakening in these auctions of some sort of bond vigilante behavior focused on inflation?
The president reopened the government yesterday. One of the first lines after he signed that document, let's make America affordable again. Now, what direction are we going in here? We've heard about $2,000 checks and tariff relief. I think the auctions matter in the future if we go in that direction, because that means we need to issue some more treasuries.
Thank you for leaning into just how interesting these auctions are, because it is true that at some point it's going to be financed. It's not going to necessarily be financed in the long end. Nonetheless, the long end is being influenced by global dynamics, as well as the fact that we're looking at Google debt that's 50 years long. So when you take a look at sort of the overall issuance, you start to wonder whether you get some pushback in bond markets to some of the proposals that do speak to maybe not getting back down to 2% anytime soon.
We haven't had much pushback so far this year. There was a brief moment in April, yes, but on the year so far, yields are lower on the year and not higher. 10s this morning, still around 4%.
You know, one of the difficult things to discern, how much is this a fundamental bet and how much is this a technical bet? That the Treasury Department is going to sell less longer-term debt, that maybe the Fed's going to use their balance sheet a little bit more, that there is this goal to get 10-year yields lower in order to restart the mortgage market. How much is that part of why yields have remained so contained?
Limit long property in Florida and US equities.
Is that
how
what
this
you're doing?
works? But if this is the direction we go in, and this is what we heard from Eric Johnston of Cantor in the last hour, he was talking about lower rates, a more aggressive balance sheet policy, accommodating aggressive fiscal policy, a $2,000 check followed by another $2,000 check. If that's the direction we're going in, yeah, it's a buy everything story, isn't it?
Long stocks, long toilet paper, because it reminds me of that era.
And get long inflation too. If that's the direction we go in, it's not my call, but people are making that call for 26.
And how much is this part of the reason why everything is rallying in tandem? Usually you would think of bonds and stocks being inversely correlated. We haven't seen that consistency really restart over the past couple of months.
Buy everything except the Fed's credibility, if that's the direction we go in. A lot of ifs there for 2026. Coming up this hour, we'll catch up with Kevin Gordon of Schwab as stocks are edging lower. Chris Caso of Wolfe Research remaining bullish on tech despite recent volatility, and Tiffany Wilding of Pimco with markets now awaiting the release of key economic data. We begin this hour with the latest stock rally on pause following the end of the longest government shutdown in history. Kevin Gordon of Schwab likely saying this, likely we'll have to wait until the beginning of 26 to get a clear read on the health of the labour market, raising the risk of a shock to markets, especially if the delayed jobs report are released all at once. Kevin Gordon joins us now for more. Kevin, good to see you.
Hello, John Ferro.
I get that right. Thanks for catching up with us. Let's talk about this market and the prospect of $2,000 checks. Does that change the outlook for you, this shift towards affordability?
Well, I think the prospect of the checks, I mean, we'll see what how that actually nets out. If we learned anything from the past 5 years of issuing out checks to Americans and directly giving them money in several rounds, yes, you could argue it contributes to an inflation problem, but it also doesn't solve anything on the sentiment or the confidence front. As you pointed out earlier in the show, alluding to this vipression that we've started to think about, sentiment has only continued to get worse as inflation has remained sticky and above the Fed's target, and price levels have been, still so egregiously above where they were pre-pandemic. So I'm not so sure that it's necessarily going to be an elixir for what ails a lot of the economy from a sentiment standpoint. And then I think from an inflation standpoint, more importantly, I certainly don't think it'll do anything to help bring, inflation a little bit lower, because even if you take out what was a really strong disinflationary force in the September CPI, which was shelter. I know there's a lot of controversy around excluding certain components, but the core parts of inflation are still relatively sticky. If you do core services, ex-housing, and CPI, you're still running above 3% on a year-over-year basis. That hasn't really budged. You look at a chart of just general year-over-year change in CPI, that's hovering closer to 3% on average, not 2%. So there is a little bit of a difference in the inflation backdrop post-pandemic, and we're sort of living in and experiencing it real time.
Every day that passes, this becomes a dated conversation because we don't have updated data.
Yeah.
And might not get another CPI report for quite a while. What's been the biggest problem for you, the absence of data or the data we have seen?
I think it's been the absence, and I think it will be the absence for a while. As you alluded to in the quote, I'm getting sort of more convinced that it's going to take until probably the end of January, maybe well into the end of the first quarter of 26 until we get a clear read, at least on something like the labor market. Because we're looking at this data hole in October, HOLE, not WHOLE, where you're likely going to miss, even if you get some reports like the non-farm payrolls report, it's probably not going to be clean. I mean, retroactively, you have to ask businesses, for the establishment survey, what the employment situation was like. I think the likelihood you get the household survey is pretty low, which that's not going to mean that the payroll number is meaningless, but I think it will take down a lot of the sort of, the scale of it, or at least the importance of it, because if you have the payroll number but you don't have the unemployment rate, we don't really understand what the supply situation is looking like. So because of that, and because you're going to then be missing revisions, and you're also past the reference period now for November. I mean, there's a whole list, and I could go on. But I think all of that adding up gets you to a point where into the first quarter of 26, you probably have maybe a little bit of a cleaner read on labor. Plus, you get the benchmark revisions towards the beginning of next year. So that's going to also be a pretty key driver.
So let's talk about the vibe session turning into a vibe-pression, the idea of how much you have seen sentiment data fall off a cliff. It has recently been gut-checked by the hard data coming from the government that actually things are okay. And you're seeing that gut check, if there is one, right now coming from the earnings. Is this something that's sustainable, the sort of breakdown between the vibes and how people feel and what actually is going on in economic activity?
Well, it's sustainable in the sense, and I'll give a hat tip for Vibe Session coined by my pal Kyla Scanlon. So we're sort of building on the framework that she established. But I think that it's sustainable in the sense that it's become the norm, whether you like it or not. I mean, just look at the math, look at the data post-pandemic. In the past 5 years, you've only continued to see sentiment get worse. I know UMich gets a ton of flack because of maybe a little bit of a political bias and how much is driven by that. But the current conditions component of the UMich Sentiment Index is at an all-time low, meaning you have a base of consumers saying the current environment is worse than the financial crisis, it's worse than the 1980s, it's worse than the late 1970s. So I think it's sustainable in the sense that sentiment in this cycle, and I think for at least the near to medium term, is not going to be an indicator and a forward-looking indicator for the trajectory of the economy. And I think that's somewhat consistent with how the base of growth has been shaped this year, where it's become narrower, it's become increasingly driven by business investment. Clearly, as we've all talked about every single day, the AI CapEx portion of that on the tech and the software side, the hardware and the software side. So I think it is consistent with what has happened in the economy and how things have developed. But I just don't think it's going to be that traditional leading indicator for the economy, because it hasn't been.
It's a leading indicator, though, for politics. And
Yes.
there is a feeling right now that is going to come with some proposals. And you were talking earlier about the $2,000 checks that could come out. And I just wonder whether the bond market is starting to price in, or when it will start to price in, a series of potential proposals that John's been outlining could potentially be quite stimulative.
Yeah, well, I think from the bond market's perspective, when we came, I sort of rewind back to a year ago when we were all putting our outlooks together for 2025, and collectively we were assessing, what is the policy risk, both from Washington but also on the monetary policy side. And you do have almost an equal set of headwinds and tailwinds for the equity market, but also the bond market. You think about things that are more growth negative, like tariffs. I mean, we do have elevated tariffs. We're probably going to be living in a high tariff world for the foreseeable future. But you also have some form of fiscal stimulus coming from the Big Beautiful Bill, but also potentially coming from additional measures, whether it is checks. So in that sense, and I think, you pointing out the sort of the little move down that we've seen in the 10-year over the past year. But if you zoom out over the past several years, it's kind of been stuck in this range. And that makes a lot of sense to us because of these competing forces that you have. So I don't see a whole lot of that changing, especially because the business investment environment is still so fertile and it's so strong right now. And you're expected to get a little bit of a bounce back in consumption with, when we get third quarter GDP. Of course, fourth quarter and then into first quarter of 26 is going to be distorted by the shutdown. But there's still no indication, because of the stock of labor is still so high right now, there's still no indication that you're seeing this massive drawdown in spending. And we've had some alternative data that have underpinned that and emphasized that have shown that, retail sales haven't fallen off a cliff. The weekly economic index from the Dallas Fed is still pretty stable. So we've been able to see that the consumer is still broadly resilient.
Can we just finish on the setup for 26 in markets? So 12 months ago, a lot of people bulled up on Buy America. When we went to Davos, Switzerland last year, it was ridiculous how long everyone was one theme, and that was the United States. What happened? An out-of-consensus rally in Europe. Lasted for the first half of the year at least, but it was massive. How do you think we're set up with that in mind for 26?
I think that, to the extent you get a little bit of a reversal in some of the forces, like the falling dollar in the first half of this year, that was almost to the date a one-half 2025 story. The dollar is stabilized, and it's actually, last I checked, I think the best performing out of the G10 so far in the second half of the year. So even if that stays relatively stable, or you get a bit of a pickup because you have rate cuts that are priced out from the market in terms of the Fed, I think that can maybe work against some of the, the ex-US trade, particularly in Europe. But, the setup for the US, What I think has become really important to watch, and this is sort of manifested over the past couple of weeks, and importantly this week so far, where the breadth picture under the surface for the S&P 500 has actually started to improve. So there's been a little bit of closing of the gap between, the equal weighted index and then the cap weighted index, where even though you're seeing some digestion over the past couple of weeks, there has been a little bit of a catch up from the average stock, which is really important because by the end of October, you're at 26% of members in the index that were outperforming the index on a rolling 3-month basis. That's incredibly low relative to history. So anytime you go through that sort of washout down the cap spectrum and outside of the top 10, you really need to see that gap close in favor of the average stock, the so-called average stock. And so far, that's happening. So I think it's a relatively healthy sign. But what needs to happen, I think, in the next 4 to 5 weeks is a pickup in what I think of as sort of the holy grail metric for breadth, which is the share of companies that are above their 200-day moving average. That's come back up to 60%. So I think if you continue to see that climb as the index health improves, then I think that has gives you a relatively solid setup for 26.
Kevin Gordon, always smart. Thank you, sir.
Thanks, guys.
Appreciate it.
Nice
Thank
to see
you.
you.
Kevin Gordon there of Schwab. The dollar this morning down by about 0.2%. I checked the WCRS function on the Bloomberg terminal just to, half to date. Just about level pegging with the Norwegian krona and the Swedish currency.
Right.
So almost, and I'm sure that was true 24 hours ago. So very cool. I hadn't checked that for quite a while. Thanks for that. I love that function too. It's one of my favourites. It's brilliant. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Shares of Cisco Systems soaring today after the network equipment giant boosted its 2026 forecast, showing progress in its effort to capture more artificial intelligence spending. The company now expects sales of as much as $61 billion in the fiscal year. That's about $1 billion more than it previously expected and higher than Wall Street estimates. Scion Asset Management, the hedge fund run by Big Short investor Michael Burry, has deregistered with the SEC. A filing shows registration was terminated November 10th, and Burry said in a social media post that he was, quote, on to much better things November 25th. Burry's post also detailed his bet against Palantir in the post, saying he had spent about $9.2 million and that had let him sell shares at $50 in 2027, those options. Well, after 50 days of waiting, Arizona Congresswoman Adelita Grijalva was sworn in Wednesday. Speaker Mike Johnston had said he wouldn't swear in the Arizona Democrat until the government shutdown ended, and the delay prompted outrage from Democrats. Before the ceremony, Grijalva had been unable to perform basic constituent services or even open an office in her district. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus, Chris Caso of Wolfe Research, as he remains bullish on tech despite recent volatility. That conversation just around the corner.
Even though there's these worries and these concerns, I think tech will ultimately still lead. If you believe you're in a bull market, I think ultimately tech has to participate and likely lead, even if there's some bouts of underperformance. If things slow down, money moves back to tech. And if the Fed cuts rates, people still stick with tech because of the financing side and the secular growth.
That was Keith Lerner of Truist on the programme a little bit earlier this morning. If you are just joining us, a softer tone so far this morning. No real drama, though. We're down by about a tenth on the S&P. Likewise on the Nasdaq. The Russell small caps down by 0.4. That's the price action in the equity market. Let's get you some morning calls. First up, Piper Sandler raising its price target on Cisco to 86, highlighting its solid web-scale AI infrastructure build-out. That name is up by 7% this morning. Your second call from Morgan Stanley naming Micron a top pick with a street high target of 325, expecting new earnings-driven highs. That stock is up by 0.9%. And finally, Wedbush adding Meta to its best ideas list, citing positive commentary from Meta AI and Super Intelligence Labs. The stock is up by 0.6%. Let's stick with tech. Concerns surrounding the AI narrative whipsaw in stocks over the last week or so. Bloomberg's Michael Ball joins us now for more. Michael, welcome to the show. We've seen some pushback a few times against certain names, Meta, Palantir. Take stock of things now. Where are we?
Yeah, it's good that we had the Cisco earnings come in positive on the AI front. Obviously, there's a bigger story there with the networking, cloud computing components being the main driver, but also upgrading their AI outlook, coming off AMD after that as well yesterday. So we've stabilized a little bit as far as worries that came last week and earlier in the week. So it's good right now. I think literally you're seeing people holding on to their longs. You've seen some trimming, but generally the secular story is still intact. But look, we have lots of questions, and those questions are not only about just how long profitability will be as we move from sort of training into inference and this $3 trillion, secular saga, but also the power story, as you guys have covered quite well. The power story is key, and I think it's very interesting now to think about where we're going to get the bottlenecks. And you've been covering it very well, and I believe we're starting to see the pushback there come mostly in the derivatives now. The plumbing of the power story now is now being questioned, how quickly these guys can pivot. What's the backlog story?
Michael, you mentioned Cisco. Is a number just a number? When you see Cisco in the pre-market in the high 70s and you compare it to where they were in the early 2000s, is a number just a number? Yeah, I think a number is just a number. And I was writing sort of about this .com comparison yesterday. We are in a different era. I believe that it is interesting, and I did not realize that it'd been 2 decades. But ultimately now the story is much more positive. Clearly it tells the frothiness of the times of past. But we do have a longer-term, CapEx drive here that Cisco's going to benefit from. And again, we need to understand what the real constraints as the rubber hits the road. And I thought it was interesting, funny enough, that as you're talking about Michael Burry changing the strategy, the structure of his hedge fund, or closing it, he had an interesting note out talking about how the chips are going to be depreciated now at a faster level because the power story is so important. So the newer chips are going to use less power, are going to hold value much more than older ones. And even though there's still a lot of value in the capacity they have to do the training and to do the inference, the real drive will now be to be more efficient, and that's going to increase over the next couple of years as we hit sort of this grid constraint and the on-site backlog. Michael, thanks for catching up with us. We appreciate the update. Michael Bull there of Bloomberg. Chris Caso of Wolfe Research, remaining bullish on AI, writes the following: a significant number of deal announcements over the last several months have provided greater visibility into the outlook for AI revenue growth going forward. Chris joins us now for more. Chris, welcome back. 6 days away from NVIDIA. What are you expecting to see next week?
I think it's going to be a good report, and for a couple of reasons. One is that earlier in the year, NVIDIA was constrained by the production of these server racks. And one of the things that's happened in the move to this new Blackwell generation is they don't just do the chip and the board, they do the whole racks. It was a little challenging getting that there. So we didn't see quite the earnings beats that we've come to expect from NVIDIA in the first half in the first half of this year as compared to others. That part is settled. Obviously, demand for AI is very strong. And they give some disclosures at their GTC event in Washington, which we think points to, some pretty significant upside in the second half of the year, but more significant upside as you go into next year. So we think all systems are still a go here.
How important, Chris, is concentration risk? And I'm not talking about NVIDIA as part of the S&P 500 or the NASDAQ, but with respect to their client base. How important is it to see it start to expand outside of the main hyperscalers and into other businesses?
Well, NVIDIA, I would say they are pretty well diversified right now. And in general, the way we kind of look at the AI market is about half of the market is, those big cloud providers doing their own internal workloads. That's the biggest demand right now. But the other half is really kind of everybody else. And, every, Fortune 500 company, every enterprise has their own AI strategy. What you're seeing is sovereign AI, a lot of countries themselves that want to use their own local knowledge and put that into models. And that's still about half the market. Now, a lot of that market is actually served by cloud providers because of the scale. But, the thing is with AI, everybody's using it right now. And it's really just a question of where is the capacity going to be put and who's going to apply that capacity. And those are the questions that we're answering now.
6 months ago, Chris, we'd be talking about national security probably as one of our first questions, and how much NVIDIA was constrained by national security considerations and potential bans or restrictions on selling certain chips. Now it seems to be off the table with the potential of an upside surprise from certain chips getting signed off on and sold into places like China. How are you trying to understand that side of the story in this earnings report?
Well, for right now, we don't expect that there's any China revenue either in the numbers or in guidance. one of the things AMD said on their earnings call is they do have some licenses to ship some things to China right now, but it's very small. Obviously people were watching the China-U.S. trade discussions to see if anything changed there. It really didn't. So at this point, it's a relatively minor part of the story. As I look at where our 25 numbers are, it would have maybe been high single digits of revenue because you've got so much growth next year. China just becomes smaller and smaller unless there's some change in, what NVIDIA could ship to China. If they could ship their most advanced chips, it would be much more significant. That probably isn't going to happen for right now. And as long as that's the case, then China becomes a very small part of the story.
Chris, there's obvious genuine demand happening here, and we can see that. And there's obvious genuine profits being made, and we can see that too. Chris, there are some questions, though, about the spend commitments that have been made by companies like OpenAI. How realistic are they based on the revenue they're currently generating?
Well, and I think based on the revenue they're generating today, you'd put a question, which is why the questions are out there. But the way we look at it is that right now, this is a battle for relevance right now. And we're in the very early stages of AI. OpenAI has made a stake. They're going to spend a lot of money right now over the next 2 years. Ironically, part of that money is coming from NVIDIA themselves. It made a very big investment in OpenAI. So OpenAI has the cash to do it. And in some sense, we think OpenAI has laid down the gauntlet. Here's what we're going to spend. It requires a lot of spending to get to agentic AI, which we think is what's going to be the driver over the next 2 years or so. And the question now for Google, Amazon, Microsoft, everyone else is, because OpenAI is doing this, we have to do this also. And we think it drives the spending at least over the next 2 years. After that point, after the capacity is in, after we figure out what agentic AI really means in terms of monetization, then there's going to be a question that says, have we built too much? Did we not build enough?
Yeah.
But at least for the next 2 years, we think that that spending is pretty well set because no one has any choice. If you don't spend it, you're going to be left behind.
Chris, appreciate it. Thank you, sir. Chris Caso there of Wolfe Research, confronting what looks like existential risk, driving massive spending in that sector. Up next, Tiffany Wilding of Pimco. Stocks are down by 0.2% on the S&P, likewise on the Nasdaq. The longest stretch without losses on the S&P 500 since late October. Let's see if we can avoid it for a fifth consecutive session a little bit later this morning. As we count you down to the opening bell, 60 minutes away with your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with Alibaba. ADRs are rising 4% on our reporting that it's planning a major overhaul to its flagship AI app, renaming it Qwen. And the goal is for it to align more closely with OpenAI's ChatGPT. It also plans to load it with shopping features tied to Alibaba's massive e-commerce platforms. And this marks one of its biggest bets yet to make money off consumer-facing AI services. Meanwhile, moving on to Disney, those shares sinking further, now down 5.3% as Disney's bracing for a pricey start to the year. The studio is spending big on blockbusters like Zootopia 2 and the latest Avatar, and that's expected to weigh on results in the first quarter. It did see some bright spots with the parks and cruise division performing well. It also expects earnings later next year to improve in the double digits, but that's not impressing investors this morning. And we end on Nike shares. They are rising 2.75% after Wells Fargo upgraded the stock to overweight, saying it's lacing up for liftoff. The analyst's words, not mine. He says that there's finally better visibility on revenue and margins after it dealt with a series of headwinds, whether it was tariffs or inflated inventory. Plus, they say that innovation and new strategies by CEO Elliott Hill, who's been in the post for about a year now, are starting to pay off. John?
The turnaround effort continues. Yahara, thank you. The stock is higher by 2.8%. Let's turn back to the economy. The White House warning Wall Street may never see October's official inflation and labor market data.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
Bloomberg's Mike McKee joins us now for more. Mike, likely never, how likely will it be that we don't see those numbers?
Well, we haven't heard from the people who put the numbers together. We've just heard from the White House PR effort. So I wouldn't put too much stock in that. It's going to be a few days before we get any kind of timetable on when they can put things out. But according to people I've talked to, they think that there is a possibility they can get at least part of the jobs report, at least part of the CPI report out, because some of that data comes in electronically. And in some cases, for the jobs data, for example, they can go back and ask companies about their payrolls. Those records will be there. So expect the September jobs report next week. That was prepared before the shutdown started. And PPI is largely information that comes in electronically from companies. Retail sales, obviously the retailers know what they cook in during the month. So maybe it'll take them a week or so to get that data all put together in release form, but that should come out. October jobs is the question. They think there is a chance they get a partial. They may not get the unemployment rate because that's a telephone survey in many cases. But in terms of the total jobs numbers, again, that's data that comes in on a regular basis. And the rest may come in early December. It'll just take them a while to put everything together, all the data that's come in that hasn't been analyzed yet.
Mike, how difficult is it going to be for this Federal Reserve to produce the SEP in the middle of December, looking out to next year and beyond?
It'll be a little more difficult, but as we've discussed before, most members of the Fed will tell you they talk to so many companies, so many CEOs, and there are enough alternative data sources in many areas of the economy that they have a pretty good view to what's happening. It may make it a little harder to round off their SEP forecast to a specific decimal point, but in general, they'll be able to kind of tell what's going on. What we probably won't see, though, is a major change in the dot plot, because as you see, we still have Fed people speaking on a regular basis, and they're still as divided as ever over who is thinking that we need to cut rates and who is thinking that we need to stay where we are.
Mike McKee with the latest. Mike, thank you, sir. Looking forward to hearing directly from the BLS about what we won't get, what we will get, and how quickly we'll get it.
A lot of uncertainty about what the connection is between the White House and the BLS, which is an independent agency, and whether their decision-making will actually be influenced. Andrew and Hollenhorst and the team over at Citi coming out with this, saying we expect the jobs report to be released in late November or early December, despite speculation that it might not be released at all. So the view from Wall Street maybe is skeptical about what the White House is saying.
Are we calling it speculation, what we're hearing from the White House press secretary?
That's what I found very funny.
That's what Wall Street's describing this
Caroline
as.
Levitt is speculation.
OK, we're speculating about what we might see and how quickly we'll see it. Tiffany Wilding of Pimco writing, we expect the BLS to publish a data release schedule relatively soon. However, it could take a little more time in this instance based on the length of the shutdown. Tiffany joins us now for more. Tiffany, how would you describe what we've heard in the last 24 hours? What do you expect to see and how quickly do you expect to see it?
Yeah, so we were also surprised by the White House comments on the BLS, and we are ultimately waiting for them to get back in the office and release a data release schedule. So in the past, it's been 2 or 3 days back after a shutdown that they put out a new schedule and then they tell the world what they can do and when. So we're kind of waiting for that to be the true arbiter of what's going to be released. Ultimately, we agree with Mike McKee. We think at least half of the employment report can likely be released because it's electronic. The so-called establishment survey. So they should be able to do that one. The household survey, which requires actual surveyors, might be a little bit more difficult. But ultimately, we think that one is also possible as well eventually. So we're also a little bit skeptical. We think the BLS should put out the data ultimately. Try very hard to do so. And clearly the timing here is going to impact the Federal Reserve decision in December. They're basically saying they need more data to understand what's going on in order to make a move.
Tiffany, how much have you been able to plug the data from your end of things based on alternative sources, based on earnings, based on sentiment surveys?
Yeah, Yeah, I mean, when we look at the range of data, basically the conclusion that we come to is that the momentum has continued to slow, but that slowing has still been relatively gradual. So we're not falling off a cliff. The labor market is not, sort of plunging into the abyss, but nevertheless, it's continuing to lose momentum. I think maybe a little bit more concerningly is that we have started to see some early indications of actual separations or job losses picking up. We've seen various corporate announcements on this. The Challenger survey, which leads warn data, which is companies have to warn their states of layoffs. That has started to tick up. That also tends to lead claims, by around 3 months. So it does suggest there is, some potential for job losses. Now ultimately, how big that will be is obviously difficult to gauge. But I think there is enough evidence here for the Fed to continue to cut rates, at least one more time from a risk management perspective.
There's this debate right now, inflation or jobs, and the dual mandate very much in conflict. And Eric Johnston of Cantor Fitzgerald was on the show earlier this morning, and he said, ultimately it comes down to, yes, sure, the labor market has seen some cracks or at least some slowing down. It seems as though the Fed has abandoned their goal of 2% inflation. And for the most part, that is going to drive policy to be more accommodative and responsive to the labor side of things. Do you agree with that?
No, I actually think that the Fed is trying to be, I think they're trying to be more forward-looking here, and they're trying to assess, they're very wary that inflation is above target. I think they probably would have moved faster. We wouldn't be debating December if inflation were lower right now. So I certainly think that the Fed has their eye on inflation as well. I think the big question in terms of these increasing downside risks to the labor market, is if those risks do materialize, you have opening of slack that is ultimately going to put downward pressure on inflation in the future. So I think you have to weigh both sides of the mandate here. The Fed seems to be doing that, and that's why they're, some of them are more cautious around December.
Tiffany, can you help us identify some durable sources of disinflation looking out into next year?
Well, ultimately, I think if underlying everything, discussion of the tariffs, we've certainly seen more tariff pass through. There's evidence of that in the data. But on the services side, the economy has continued to cool. Services inflation, rental inflation has taken longer to come down after the pandemic, but it is trending in the right direction. We think that the immigration boom in the last several years also slowed down the moderation of rent inflation. That immigration policy shift that we've seen from the administration this year is moderating rental inflation again. And we're seeing broader services inflation also moderate. There's some noise in travel services more recently that's resulted in some reacceleration, but we ultimately think that will come back down as well. So I do think if you look under the hood at the details, there are some very encouraging signs that inflation is moving back to target. I think that, again, the concern here is that the Fed has is that you have this tariff-related inflation that keeps it persistent, and you have inflation expectations that are setting somewhat higher, and that just keeps inflation persistent. And that's certainly the risk that they see, and it's ultimately why they're being more cautious.
Tiffany, always good to catch up. Thank you. Tiffany Wilding there of Pimco with the latest on their assessment of where we are. Neil Dutta of Renmac, pretty punchy this morning. Talk about revealed preferences. The hawks are getting louder. The data does not support them. He identifies some sources of disinflation for you, declines in used car prices and renewed slowing in housing rents. That's what he's pointing out this morning. Yeah, which really speaks to what you are seeing in certain pockets, especially where there had been building, and particularly in the Southwest and in the Sun Belt. At the same time, he also, to your punchy side, comes out with what San Francisco Fed President Mary Daly had to say earlier this morning, which she said that ultimately it's premature to say whether they're going to cut or not cut in December. He said, it probably means that December is kaput. No December means no January. Bye-bye. So there is this feeling that if they don't cut next month, it could mean a series of pauses, to the point that you made earlier. Is this developing into a prolonged pause at a time where certain segments of this economy are really struggling? I saw some data from Fitch Ratings yesterday. I'm sure you saw the same thing, that the share of subprime borrowers at least 60 days past due on their auto loans has risen to a level we haven't seen in data going back to 1994. Yeah, raising concerns yet again about the consumer quality, the consumer credit quality at the lower ends. That said,
You get 5 people who point to the subprime auto loan story and speak to the auto sector during the pandemic and immediately thereafter. And then you get 25 people pointing to the consumer credit surveys done out of Bank of America and Citibank showing that consumers are spending and are actually repaying their credit card bills. So it's a tale of two consumers. It's a tale of two different sectors. How do you deal with this?
Then you've got tech investors just pointing to earnings and saying, look at markets. All-time highs on the S&P 500. Very close to those levels this morning, pulling back just a touch. We're down 1/3%. With an update on stories worldwide with your Bloomberg Brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Starbucks baristas are launching a wave of walkouts across the country. More than 1,000 baristas chose to do this on Starbucks' annual Red Cup Day, known to draw large crowds getting their reusable holiday-themed cups. The strikes will take place in at least 40 cities and could expand if there isn't progress towards finalising a union contract. The International Energy Agency, or IEA, has increased its estimates for a record global oil surplus next year. The agency expects that world oil supplies will exceed demand in 2026 by just over 4 million barrels a day, saying global balances are looking increasingly lopsided due to rising oil supply and relatively modest growth in demand. For the first time in 168 years, the US is officially retiring a coin. The US stamped the final set of pennies at the Philadelphia Mint on Wednesday, marking an end of the production of the smallest denomination of US currency. This all after President Trump ordered its discontinuation. Don't worry, if you find pennies lying around, it remains legal tender. Apparently over 300 billion remain in circulation. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Lisa Hornby of Schroders as markets look for direction on the Fed's next move from New York City. You're watching Bloomberg TV.
Breadth picture under the surface for the S&P 500 is actually starting to improve. So there's been a little bit of closing of the gap between, the equal weighted index and then the cap weighted index. It's a relatively healthy sign, but what needs to happen, I think, in the next, 4 to 5 weeks is a pickup in what I think of as sort of the holy grail metric for breadth, which is the share of companies that are above their 200-day moving average. If you continue to see that climb as the index health improves, then I think that has gives you a relatively solid setup for 26.
That was Kevin Gordon of Schwab looking ahead to 2026. The year ahead season is just around the corner. What are we, about a week away, you think? Going into Thanksgiving?
The pace that we're going without data, I think that we're there. I think that people are already
just hit send, release.
Nothing's going to happen.
Publish.
I mean, at this point, let's just go on vacation.
S&P 500 forecast just around the corner. Equity futures on the S&P 500 look like this. We're down by 0.3%. On the Nasdaq, we're down by 0.4%. On the Russell, down by 0.6%. In the bond market, a bit of a lift developing here, particularly at the front end of the curve and through the belly. We're up by 3 or 4 basis points now. 2s out to 10s. 10s up to 410.95. 2s back through 360. Fed hawks making some noise in the last couple of days.
Yeah, Susan Collins in particular, from the Boston Fed, given the fact that she is a voting member, talking about how inflation is really the preeminent concern. This is the battle. And we're going to hear, honestly, all of the Fed officials lining up on either side. It is a soup right now, not only because we don't have data, but because it's very hard to know whether to focus on the near-term inflation targets, whether you're looking at unemployment rates that are still fairly low, or whether you're looking at a seismic shift in technology that's setting up for a very different paradigm in the months to come.
Tons of Fed speak still to come through today and into the weekend. The lineup looks like this today. A busy day of Fed speak, including Muslim and Kashkari. On Friday, you'll get comments from Schmidt, Logan and Bostic. Looking ahead to next week, attention really shifts back to the earnings of the consumer. Home Depot, Target, Walmart in the mix. Nvidia dominant. Nvidia earnings dropping Wednesday after the close.
Can it confirm all of the optimism around the AI transformation that frankly is the trade? And it's not just in stock markets, but it's also increasingly in the market of credit.
Let's turn to credit, fixed income and the Federal Reserve. Bond yields inching higher this morning as traders look ahead to the central bank's December meeting. Lisa Hornby of Schroders writing, we continue to believe that persistent labour market softness and mounting pressure on lower income households will keep the FOMC on track for a December rate cut. Lisa joins us now for more. Lisa, good morning.
Hi, how are you?
Is that becoming a closer call?
It is, and I actually think the Fed is doing a pretty good job of keeping that optionality, right? Powell came back out kind of after the press conference saying it's not a done deal. Don't think it is. But at the end of the day, our view is that the data we have seen, particularly some of the layoff data, has deteriorated. And so they probably will prioritize, at least for this meeting, the labor market over the inflation side of the equation.
Are we taking this meeting by meeting, just 25 at a time and work out where we land?
I think we are, and I think we should be. That's fair, right? The economy it's not bad. I mean, growth-wise, I actually think next year is going to be a kind of a weird year where growth can actually be okay, but the labor market probably continues to soften a little bit. Possibly because of the reasons that growth is okay, the AI spend, some of these numbers that are coming out, CapEx, it's possibly in contrast to the labor market. But the Fed is going to have to figure out what things do they prioritize in this. And, December, I think they probably lean towards the labor market. Next year becomes a little bit more of a question.
Let's say the Fed does cut an additional 25 basis points next month, and let's say they signal they are open to doing more next year. What are your clients going to do with some of their money market funds? Is that enough to kind of push them out into, say, longer duration or even into 50-year alphabet bonds?
Well, let's hold on the alphabet question for a second. But I think that's the right call, right? There's been a tremendous amount of money parked in money market. This has been a great call. I think some of that is going to find its way into longer duration as we continue to see yields fall. We have seen it, and I think we're already starting to see some of that money shift. I think there's probably more to come. I mean, unfortunately, generally retail tends to be a little bit late to that, so that we may get the money in as we're reaching the bottom of the Fed cutting cycle, but I do think that probably will be happening.
So let's talk about the 50-year alphabet debt, not necessarily whether or not you bought it or anything like that, but I am curious how much you are seeing fund managers pushed into greater risk in a way. They're looking for the same kind of income. They're looking for outperformance. AI is the hot trade. Yep. How much do people almost feel forced to absorb this incredible glut of debt issuance?
So there's a lot of questions in that question. I think one of them is the market is shifting quite dramatically in terms of tech and what that means to the bond markets, right? Some of these issuers are forecasted to become the largest issuers in the corporate index in the next few years, kind of surpassing, potentially surpassing some of the Verizons and the AT&Ts, the larger non-bank issuers. And so that's a really structural and fundamental shift that I think investors need to get their heads around. What does it mean? Meta's issued massive amounts of debt just in the last 6 weeks. Their balance sheet and the structure of the company in terms of how they fund is changing dramatically. So I think there's a big question as to what does tech look like in the corporate index in a year's time versus what it was maybe 6 months ago. I think investors are looking at that, but there are other opportunities out there that aren't as crazy risky. Look at tax-exempt municipal bonds. I think maybe last time I was on the show, we might have talked about them. They underperformed treasuries at one point this year, 6.5 percentage points. This is not a crazy risk trade.
Are you saying that the other is crazy risky?
I'm saying that you can buy local government debt at pretty reasonable yields compared to treasuries and actually have some alpha generation potential there because they have underperformed this year. Google didn't exist 50 years ago. So I'm just putting that out there. I'm not saying it's not going to exist in 50 years' time, but there are questions about that and their funding mechanism.
You keep alluding to it slowly, and we'll keep coming back to it. Are you worried about corporate credit?
Look, spreads are tight. I think that there is probably a repricing that's going on in the tech sector, and I think those curves need to steepen. There are some interesting issuers that are coming today, possibly today, actually. Yeah. But I don't think we can paint them all with the same broad brush.
As they issue more, does it make it a higher quality index or a lower quality index?
So we were just doing some work on this yesterday, and I'll credit Morgan Stanley. They are the ones who came up with the stat. They said they think that the big four hyperscalers can probably issue $700 billion without impacting their ratings. So, I don't have better insight than them. These guys have been looking at this very closely.
Over what period?
I don't know if that was a year or a couple of years.
$700 billion without
They don't think
impacted
that's
their
what
rating.
the issuance will be. They're just saying that's what they think they
But ultimately, that's a green light for them to issue, to borrow.
And by the way, the cost of equity versus cost of debt, they might as well be funding in the debt markets. So I think there's a lot of issuance to come. There's a lot of data centers to be built, guys. A lot of demand for this stuff.
They're amazing numbers. Lisa, thank you.
Yeah.
Thank you very much. Lisa Hornby of Schroders. That's the green light to borrow in the debt market, which is why they're doing it.
I just wonder, to Lisa Hornby's point, and I think it's a really important one, the index is fundamentally changing. And the AT&T and Verizons of the world were the harbingers of a complete cycle that was very much one of boom and one of bust. And I wonder how much that's being appreciated in a market that's absorbing this as investment grade credit, even if potentially it's getting increasingly risky based on the changing of the capital structure of these companies.
These tech companies are changing. The reasons they're issuing are changing. Fundamentally, they're different companies. Looking out 5 years compared to what they have been historically.
Looking out 50 years, if you want to take a look at Alphabet,
which is... I just don't have that visibility.
I think that nobody does, which I think is part of the issue. But this really raises a question. At what point do you get real pushback? And at some point, are fund managers being not forced to take this on, but deeply encouraged if you have both the growth profile that's being represented in the earnings calls, but also by rates that, yes, they are relatively high versus the pre-pandemic period, but otherwise, are they tight? That's the real question.
Bond yields a little bit higher today, up by 3 or 4 basis points, 410.57 on 10s. Coming up tomorrow, Francisco Blanch of Bank of America, Sarah Bianchi of Evercore, Darryl Cronk of Wells Fargo, Michelle Meyer of MasterCard. Live from New York City this morning. Good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 4 at the Nitto ATP Finals. Jannik Sinner became the first man to punch his ticket into the semis with a comprehensive win over two-time champion Alexander Zverev. Sinner's looking to successfully defend the title he won in Turin a year ago. Earlier, Felix Auger-Aliassime clinched a vital victory over American Ben Shelton to keep his hopes of advancing alive.